As far as the stock market, I'd say it's reasonably priced for another decent year.
There's just been a lot more kind of idiosyncratic risk out there. Volatility is kind of a little bit all over the place.
What tends to happen, though, in January is all the sort of market moves that we have in December get completely unwound.
We're going through a nominal regime shift to a higher nominal GDP condition.
We trust the data, but we take it with a grain of salt. We look at a broad measure of every type of indicator.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning from New York City for audiences worldwide. Welcome to Bloomberg Surveillance. Jonathan and Lisa are still off enjoying the holidays. I'm Anne-Marie Hordern. Joining me this hour, very lucky and excited to say, is Peter Cheer of Academy Securities. Peter, thank you so much for joining me. Merry Christmas, happy holidays. Do you think we're going to get this Santa rally at the moment? You do see markets down 0.4%, but they did go into Christmas a little bit higher.
You know, I think we might bounce around for the next few days. I think we're actually going to get off to a bit of a sloppy January. I keep watching yields, and yields keep drifting higher, right? We're at 460 on 10s. I'm not sure what pulls yields back. That's working. You're seeing cryptocurrency move around, and I think the realization is DC is going to have a lot of issues facing it, and that's very unclear how it's going to work out. So I think that translates to choppy markets.
Also, choppy market because such low volume. Not many people are actually at their desks now, are they?
No, and I think that's been one of the things, right? We've had some very extremely big up days and some big down days, and part of it, there's so few traders. You allow all these leveraged ETFs to really take over the zero-day to expiration options, so I think you get bigger swings than you would otherwise. We won't really start getting a true sentiment, I think, until that first week back in January.
Right. Okay, so here's the sentiment, though. Let's check in on what markets are doing this morning. If you are up the day after Christmas, Merry Christmas and Happy Holidays to you. We do have S&P 500 futures down 0.4%. The S&P 500 did close higher on Tuesday. That extended this year's advance to 27%. Peter and I will be talking about all that happened in 2024. NASDAQ futures also softer this morning alongside Russell 200. Across asset this morning, we do have euro dollar this morning around 104. It came into the year at 110. So wow, just what a tear the dollar has been on. And then Peter has mentioned yields are ticking higher. The 10-year yield this morning at 4.6%. Coming up, Wendy Schiller of Brown University on President-elect Trump's feud with Panama. Shahzad Kazi of a China Beige Book on the outlook for U.S. China relations, and highlights from my interview with Ukraine President Volodymyr Zelensky this summer. We begin this hour, though, with U.S. futures mostly unchanged, a little bit softer following a Christmas Eve rally. Investors hoping the so-called Santa Claus rally will continue for the final 4 trading days of the year. I was looking at a stat this morning, Peter. Since 1950, the S&P 500 has generated average and median returns of 1.3% during the Santa Claus period, widely outpacing the market's average 7-day gain of 0.3%. And this is coming from LPL Financial. So actually, if you're willing to be in the markets around the holidays, maybe it'll be good for you.
You know, normally it has been. I think this year, though, everyone's kind of been looking for that opportunity to buy. We had the dip post-FOMC. I think people bought that dip. I think we've already had a lot of the Santa rally. Then we had the weird stuff that went on with the budget. I think people are going to have to digest what does it look like in the new year with President Trump, with Musk. How's the economy going to shake out? And I think that's actually going to, maybe we get the Santa rally, but I think come early January, we're going to get a lot of volatility.
So you think the market has baked in all the good stuff when it comes to Trump?
I think a lot got baked in. Again, I think you go back to post-election. Everyone was really worried about tariffs. Then all of a sudden consensus became, oh, it's just a negotiating point. He tends to like volatility. He tends to like chaos. So the more the market gets complacent, I think the more likely he is up the ante.
What do you think in terms of sequencing come January?
I think he's going to go for easy wins. So I think as he gets out there, he's going to look what can be done. So anything that can be done executive order, look for him to go ahead with that, right? Because he can do that simply. Then he's going to look for the opportunities. Again, I think we're already seeing some progress in terms of immigration. He's working with New York City Mayor Adams. So he's going to go for those high visibility, easy wins. And if he doesn't start getting those, that's when I think you see a more messy and chaotic problem.
When it comes to the easy wins, though, what the market is looking for really is a tax bill. When do you start baking in the fact that this could actually become real legislation?
I think you have to wait until you really see what people come back acting like. Again, this budget thing was kind of weird, right? There's clearly some element, certainly even within the Republican Party, that does not want to grow the deficit. There's concern about the deficit growing. You're seeing yields inch higher almost every day for the last few weeks. We have, I think it's about $12 trillion of debt that we have to refinance next year. So one, you need that demand to be there, but if we're rolling that over into higher yields, that's going to add problems to the budget deficit. So I think the deficit's going to take front and center. It's going to make it more difficult than most of us would like to get some of those policies pushed through.
You write about bonds. Be wary of bonds. Nothing from the past days tells us that there won't be a lot of spending, just the direction of the spending will be altered. You're talking about what happened in terms of the debt ceiling debacle, which pretty much went silent once they passed through this clean CR. Do you think it's going to be the bond market that is the ultimate check of power in 2025 when it comes to Washington, D.C.?
I think it will be, right? It's become, interest expense is already a big part of the deficit. It's growing. It's going to continue to grow. And the bond market, I think, is very wary, right? How are we going to pay for all these things? I think everyone out of the corner of the eye is still looking at Doge and saying, okay, maybe something gets done there. I think that's the bright shining light that's kept markets somewhat in check is, well, if Doge can really get some efficiencies, maybe we don't see the deficit balloon. Everything else, though, I think is just telling us this deficit's going to go higher, and that's problematic.
Do you see any fiscal hawks left in Washington, D.C.?
Apparently, maybe, the 27 Republicans who voted against the CR? Maybe.
38, I think.
38. So, yeah,
yes.
Maybe that's it. There is no one. It's all a matter of where they spend or tax cuts. And again, DOGE seems to be the one thing. Maybe that's where they, eke out some gains and do something about the deficit. I just don't see that happening very cleanly or very quickly.
You also say that there's hope of discipline, but, quote, the swamp seems well entrenched, so I see consistent upward pressure on bond yields. T. Rowe Price is talking about maybe 5%. Some people are even saying 6% on the 10-year yield. Do you think we can reach those levels?
I certainly think 5%'s, in the cards. 6% might be high. We'd have to see some of the policies actually get implemented. But yeah, I think 5%'s pretty realistic. Don't forget also, we might see some inflation pressures come back again. One, people were buying goods ahead of the tariffs or potential tariffs. You're seeing that. You're seeing the economy still move along reasonably well. It's that shopping season. Plus, I do think there's been an artificial bias to the data, pushing things higher than they really are in terms of jobs and inflation January, February. So that could spook the market as well. 6% seems high, though, unless we get really aggressive policy.
What do you make if we get 5% 10-year yield? What happens to this idea of U.S. exceptionalism?
I think the U.S. economy will struggle at that level. You're starting to see, small companies default pick up. You're also, one thing that kind of really caught my eye is they've gone back in Q2 and said now there were actually job losses rather than job gains in Q2. So every time they do the revisions, the economy actually seems slightly worse. So I'm not sure where we're managing to. I do think the Fed's going to be much more cautious on rate cuts. They did their 100 bips. They're sending that message. So I think we're susceptible to a yield-driven slowdown.
What does that then mean for the equity market?
I think we could see some pressure on the big high flyers. Again, so much of this market to me is about the leveraged ETFs. You have now single stock leveraged ETFs. I have no idea why those have been approved. They're out there. You're seeing a lot of hype around that. You've seen a lot of hype around, Bitcoin. It got to 100,000 a couple times. I think it crossed 99 just yesterday. Now it's back to 95,000. So I feel that's that froth that's in the market. That's where the liquidity is going to get taken out of. And it'll be pretty aggressive and pretty quickly when it happens.
Do you think there's any chance then in 2025 for broadening out, or the concentration will remain in these Mag 7 names?
I think we could see broadening out. We might even see maybe global start doing better. It's really going to come down to, I think, how many fights does Trump pick? Who do we pick fights with? Are we winning them? And what sort of policy do we get? But with higher yields, I think that's going to make it more and more difficult for this to really broaden out, unfortunately.
When you say you think globally we can potentially see pickups, where exactly?
Right now, I still wouldn't touch Europe. I think Europe's a disaster. You mentioned, I think, at the top of the show, how the euro declined.
Free fall.
So it's hard, and what scares me about Europe is Germany's kind of been the juggernaut. Germany's been what's held Europe together. They're doing very poorly right now. So I'm not yet there, but I do think sentiment's become so bad over there and so excessive over here that you do get that potential for a reversal.
Because it's so low. The entry point, is that what you're saying? The entry point
right,
is
and really
a
as a
good moment to go
contrarian, you're
in?
looking for, okay, once everyone's given up on something, that tends to be where it doesn't take much to push that around, and everyone is still so very focused. Mag 7 over here. Every time we've tried to rally, small caps, that's failed. And I keep thinking everyone's looking for that small cap rally, and maybe the surprise is going to be Europe or someone does better. I don't think it happens this month or next month, but that could be the trade of the year where all of a sudden people say, let's give the world a chance.
The DAX, though, is up so much, double digits on this year. Jonathan brings up this point all the time. Yet the German economy is on its back.
You know, I think one of the things with all of these is most of these companies are big and global. So that's one reason I think you can look at this and say, you know, I think the S&P 500, close to 50% of the earnings come from overseas. So it's the same for some of those big German companies, right? Mercedes is not really a German company per se, right? They're very dependent on global. So I think that's, you know, it's hard when we look at these things and really nationalize them when some of the big companies really are so global. And why would they trade at a much smaller, you know, as a market, lower PE? I think some of it makes sense, some of it's telco, things, banks that don't have that potential, but there is that opportunity, I think, for growth there.
The one area you haven't mentioned is China. China overnight is apparently giving local officials more leeway in how they invest government bonds. We do see them coming out and trying whatever they can to stimulate the economy. Is it enough for you to want to go there?
Yeah, I actually don't mind China as an investment, and it would be interesting when we talk to the guests later today, but I do think that this is almost an existential sort of moment for Xi and the Communist Party, so they are going to keep throwing things at this until they get the economy to turn around. And I am a big believer that their whole strategy is this made by China, so they're taking their brands, they're trying to sell them globally, they're trying to use BRICS as another way to get their brands out there. So I think Chinese companies actually might do pretty well. And again, sentiment's been awful since, you know, there was that brief flurry, you know, when everyone said, oh, we had to buy China late in the fall. It's kind of reversed again. I think there is some opportunity there. I think, to me, though, it's still a trade. It's not an investment.
You're a traveler, not a settler when it comes to China.
Definitely.
Peter Cheer is going to be sticking with us this morning. Let's get you an update on stories elsewhere we're watching. Here's your Bloomberg Brief with Yahira. Hey, Yahira.
Hi, Anne-Marie. We start with a Chinese company. Alibaba is agreeing to merge its South Korean operations with Emart's e-commerce platform as it seeks to better compete in the country's online retail sector. Sources say the new entity could be valued at about $4 billion and comes as Alibaba has been seeking to expand its international footprint to make up for slower growth in its Chinese e-commerce business. Meanwhile, Elon Musk's deputy Steve Davis is helping recruit staff for President-elect Donald Trump's Department of Government Efficiency, also known as DOGE. This is in addition to Davis's day job as president of Musk's tunneling startup, The Boring Company. Davis has helped Musk cut costs at businesses including SpaceX and social media platform X. And cleanup efforts are underway at the site of an Azerbaijan Airlines plane crash. 38 bodies have been recovered at the crash site, as well as flight recorders. 29 people survived the crash and are recovering. In total, the aircraft was carrying 62 passengers and 5 crew members from the capital of Azerbaijan to Russia's Chechnya region when it changed course to make an emergency landing in Kazakhstan. That's your Bloomberg Brief. Anne-Marie?
Thanks so much, Yahira. And Yahira have more with us in about 30 minutes' time. Up next, Trump's feud over the Panama Canal continues.
The fees being charged by Panama are ridiculous, highly unfair, especially knowing the extraordinary generosity that has been bestowed to Panama.
His grievance list continues. That's coming up next. You're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance. Merry Christmas. Happy holidays. If you're up this morning joining us, thank you. We're seeing a little bit of a pullback on equity futures this morning after the market going into Christmas on a higher note. Euro dollar this morning, 1.04. Peter and I were talking about how the euro at the start of 2024 was at 110. It's just a rip roar of the U.S. dollar. And 10-year yield this morning, yields climbing 2 basis points, 4.6%. Under surveillance this morning, Trump's feud over the Panama Canal continues.
The fees being charged by Panama are ridiculous, highly unfair, especially knowing the extraordinary generosity that has been bestowed to Panama, I say very foolishly, by the United States. This complete ripoff of our country will immediately stop. It's going to stop.
Here's the latest. President-elect Trump naming Florida County Commissioner Kevin Marino Cabrera as his pick for ambassador to Panama. This after Trump pushed the idea last week that the U.S. should control the Panama Canal. Wendy Schiller of the Taubman Center for American Politics at Brown University joins us now. Wendy, thank you so much for joining us, and happy holidays to you. Thank you for joining us the day after Christmas. We have a long list of grievances coming from President-elect Trump before he even gets into office, whether or not it's Canada, Mexico, China, Greenland, and now the Panama Canal. What do you make of all this?
Good morning, Anne-Marie. Well, President Trump, did successfully renegotiate NAFTA, at least in his eyes and in the eyes of a lot of people, trying to secure better terms for the United States in terms of trade. And this is something presidents can do in terms of executive authority. They have a trade representative. They do have a lot of leeway in determining what our economic relationships are in terms of trade and also user fees with foreign nations. And so there's a long history with the Panama Canal. And so I'm not sure how much the president will invoke that history, but he's looking for victories, and he's looking for victories that he can demonstrate using executive power and really pretty much end running Congress. Because he, was president for 4 years. He understands even with a Republican trifecta, as he saw last week, you're not always going to get your victories quickly or easily through Congress. So you're going to look to other venues and other uses of presidential power to achieve quick victories to look successful.
China doesn't control the canal at all, but it does have 2 of the main 5 ports adjacent to the canal. Is that really what Trump is getting after?
Well, I think observers would like to believe that the president wants to strengthen the United States' position vis-a-vis China in a lot of different ways. We know that China is also investing in a lot of parts of South America and also Africa, and using its resources to sort of gain leverage in those areas. That's been happening for a long time, and the United States hasn't really confronted it head on. And I think these are going to be ways in which the Trump administration looks to sort of counter China beyond even tariffs in the places that China's trying to gain a foothold.
What do you think are the top 2 or 3 things he could do basically on day one to, set that agenda and get that tone going?
Well, he can certainly issue some executive orders. He can certainly raise tariffs under a sort of national security. He can do those sorts of things. He can certainly try to block some issuance of visas or travel, like he did with the Muslim ban. There's a fair number of things presidents can do with executive orders on the first day. What he can't do is get his ambassador cleared right away. That's up to the Senate. And the Senate seems, under John Thune, the incoming Republican leader, to want to exert its constitutional privilege and really examine his nominees. Now, that examination may take a day and a half, but they're still going to go through the process. So all these ambassadors, all these cabinet levels, they have to still go through the Senate, and that's going to take a little while. So how much that frustrates President Trump, we're about to see.
Wendy, what's the Democrats' strategy for next year?
Anne-Marie, that is a question I think the Democrats themselves are looking for an answer to. It depends which faction of the Democratic Party emerges, sort of as the chief spokesperson against the incoming presidential Trump administration. We saw a little bit of playbook from the Democrats on the budget bill, referring to President Musk or co-president Elon Musk. I think the Democrats have real concerns about these non-elected influences on President Trump. President Trump, we've seen 4 years in office, there's a bit of a playbook, unpredictable, but there's a playbook. But new actors with this kind of influence, particularly with communications, presents a challenge for the Democrats. And they're trying to sort of drive a wedge between those influences, particularly Musk, and the president. Because with the president, they know what they're dealing with. With Musk, it's much more out of their control.
Right now, we still have a sitting president, Joe Biden, yet when it came to the debt, the potential shutdown, debt ceiling debacle of last week, he pretty much ceded the spotlight to incoming President Trump. Are you surprised by how much power Joe Biden is ceding right now on the global stage?
Well, I think Joe Biden and even the Democrats do want to set this up as a relationship between a Republican President Trump and a Republican-controlled House and Senate. Because whatever happens in the next couple of months, maybe things settle down, inflation goes down, maybe the economy stays solid, maybe not. They want nothing to do with that. They want to start their 2026 campaign now against the trifecta. So it's not really a bad thing for the Democrats, for President Biden to sort of not be involved. He's also doing things with executive power, things like clemency, for example. I mean, he's trying to do all he can unilaterally and somewhat quietly before the new president takes over. But right now, the strategy is to say it's the Republicans' government to run, and it's the Republicans' government to succeed or fail.
What do you think the rest of the world's going to do in response to some of these things, right? So far, we seem to be talking about this in isolation, what Trump wants to do. What's the world going to do to push back on that, or are they going to do anything?
Well, you have to think about economic markets, but you also have to think about military security and the security of Europe. And with Germany's government very shaky, with France's government shaky, and even with Great Britain's government shaky, you start to really have concerns about military incursion. You think about Putin, you think about Ukraine, the instability that could come to Europe, both economically and even militarily. That's a challenge. It's unclear the Trump administration is prepared for, and we just don't know what moves the Trump administration will make to steady the ship. And of course, the global economy will depend on steadying that ship. So those are the kinds of unforeseen external shocks that could come earlier in the Trump administration than anyone's expecting.
Trump definitely takes a more bilateral view of the world, while the Democrats or the Biden administration had taken more of a multilateral view of the world. If Trump views the world bilaterally, who do you think is going to be his best partner in Europe?
That is a really interesting question. I just haven't seen any inclination from the prior Trump administration or his rhetoric now that he's looking for a partner. I mean, he sort of wants Putin to stay in his corner, maybe resolve Ukraine and look good for that. But, Trump is Trump. And as we see in domestic politics and international politics, he is a loner. He wants to exert influence where he can and where he can be successful. But he's not really interested in giving anything to other partners. And that's something that's really strikingly different from the U.S. foreign policy posture than we've seen from a lot of former presidents.
So we're less than a month away from his inauguration, Wendy. When it comes to the sequencing of things like tax cuts, immigration policy, as well as tariffs, how do you expect all of this to play out in Washington?
Well, Emory, as you well know, because you've discussed it and reported on it before, there's a difference between Mike Johnson and John Thune on getting reconciliation going and getting an early version of the tax cut on the table and under consideration in both the House and the Senate. An early victory to extend the tax cuts, the Trump tax cuts, that would give the president a lot of momentum to focus on other things like border security. So border security he can do to some extent. If he invokes the military in trying to do border security, that will create controversy, and that could upend other kinds of domestic priorities he has, like the tax cut bill. One thing the Trump administration doesn't seem to quite get yet, which is surprising given they were there for 4 years before, is that these things are interrelated. If you ask somebody to make a politically difficult decision on, one issue, it's going to affect whether they're going to help you on another. And that's something these Republican leaders will have to manage, but it's unclear how well Trump will manage it.
Wendy Schiller, best of holidays to you. Thank you so much for joining us this morning. Peter, what do you make of that? Is that what the market is picking up on? The fact that this isn't going to be so neat and tidy?
Yes, right. I think, as she pointed out, and you pointed out, everything tends to be bilateral and it's one-off, and yet there's a history, right? And countries don't forget what you said 6 months ago or a year ago, so I think a lot of that's going to go through. I think the one thing I would say from an academy security standpoint, we're looking at Poland as being one of the big beneficiaries. We think what they've done in terms of the aid for Ukraine, how much is funneled through, how they've stood up, they will be a key component of whatever develops with NATO, and I think Poland's going to be a very good growth opportunity for next year.
We started that conversation talking about Panama Canal. But when it comes to Panama, when it comes to Greenland, what is Academy Securities, what are your generals telling you about what all these places mean in terms of China's influence?
So one, I think, go back to Greenland. I think back in the original Trump administration, he got in trouble for saying he should just buy Greenland. And then I think the Wall Street Journal did a great story about how China was effectively trying to buy Greenland. I think the Panama Canal fits into a broader story where we're increasingly worried about shipping. And we're advising clients that they really want to think about their shipping. They want to have multiple shipping routes. We're highly susceptible. We've seen in the Hormuz Strait in the Middle East, right, from attacks. You've seen the Panama Canal had just trouble because of water levels. But also increasingly, we're starting to pay close attention, right? China has invested so much through the Belt and Road Initiative in all these various ports. They have so much equipment in these various ports. I think people have to rethink shipping and take a much more serious look and not be comfortable that it's going to be there the way it is today in 5 years.
Up next, we're going to look at another hotspot right now around the world, what's going on in Ukraine. My interview with President Volodymyr Zelensky from over the summer. You're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance on this day after Christmas. Thank you so much for joining us if you're tuning in, and happy holidays. This morning, we do have equity markets pulling back. We are a touch softer when it comes to S&P 500 futures and NASDAQ futures, down nearly 0.4%, and the Russell 200 futures down almost 0.5%. Although we should say it has been a bright spot for stocks this year. The S&P 500 closed up more than 1% on Tuesday going into Christmas, extending this year's advance to 27%. Most of Europe is closed today for Boxing Days, and Asian equities were on their fourth day of gains. Switching up the boards, let's take a look at what's going on across asset. Here you have the bond board. You have yields rising this morning. Now the 10-year yield up 3 basis points, 4.61%. We should note we do have jobless claims out today at 8:30. Our survey has 223,000 claims penciled in. We also have an auction today. Lisa's not here, so I'll have to update you on what's going on in the auctions. U.S. is auctioning off $44 billion of 7-year notes. And then what we're looking at across the currency market, euro dollar today around 104. There it is, 104. I keep talking about how we entered 2024 with euro dollar around 110. The Europe has just been under pressure. It's ending the year with 2 political crises in its 2 main economies. And then, of course, the U.S. dollar has just been on an absolute tear. Under surveillance this morning, some stories we're watching. Netflix Christmas Day NFL debut went off without a hitch. The streaming giant hosted 2 primetime games yesterday, as well as a halftime show featuring Beyonce. The Grammy winner rode in on a white horse and played music from her country album, Cowboy Carter, for the first time in front of a live audience. The event was the second most popular live title on Netflix to date, according to NFL Media. So, Peter, I don't know if you watched any of this, but Netflix has had a stunning year. It is up some 90% on this stock, absolutely breathtaking in terms of how much it's growing. But now it's getting into live events. The first one had a few glitches, but this one seemed to do pretty well.
It seemed to go very well, though I guess having 2 points scored in a game by one team might be the first time it's ever finished that, so I think it could have been a more exciting game. But yeah, it seemed to do very well. I think everyone was watching. Does it glitch? Does it not glitch? It seemed to go very smoothly. We watched a bunch of it. I think it's, shows some potential. It is getting harder and harder, though, to figure out how to watch an NFL game. It's like you need like a, AI to help you find which channel these things are on.
True, and I believe Netflix also has one next year as well, right? And the following year?
Yeah, so I think, the NFL has been expanding. It plays now Thursdays, Fridays, Saturdays, Sundays. It's all over the networks. I think it's interesting. It does feel to me like it's getting harder for, a normal fan. It used to be easy, right? Saturday, Sunday, especially Sundays. Every game was on during playoff times. You kind of get the Saturday and Sunday. I don't know. I don't love it, to be honest.
It'll be interesting to see from Netflix how many people maybe signed up the day of Christmas because they wanted to make sure they can watch that game, or potentially they heard on Twitter that Beyonce was performing. If you weren't interested in the NFL, maybe you're interested in watching
I think the concert attracted as much attention as the games themselves.
Yeah, exactly. All right, also under surveillance this morning, President-elect Donald Trump doubling down his desire to purchase Greenland. In a post on Truth Social, Trump writing, quote, "Merry Christmas to the people of Greenland, which is needed by the United States for national security purposes and who want the U.S. to be there, and we will." Greenland's prime minister said the island is, quote, "not for sale and will never be for sale." You brought up a great point earlier, Peter. This is not just something the United States is trying to do. China has been trying to do this.
Yeah, I think you look, their airport's been underdeveloped. A lot of the natural resources there are underdeveloped, right? It could be a great source of geothermal energy, a lot of sustainable energy, and it's kind of been ignored, right? We all fly over to Europe and you fly right over Greenland. No one talks about it. No one does much about it. I think it's interesting. I think it should be developed. I think people have to figure out how to do. Denmark's always been supportive, but I think very little in way of support. China was trying to do much more. They were very involved both in the airport as well as some of the marine area and the energy. So I think we're going to get back in there. I think it's a huge opportunity.
This feels like vintage Trump from the first iteration. He tried to do this once before.
And I wish he would say things like invest in or cooperate with rather than buy or take over, that sort of thing. Again, I think same thing with Canada and, calling, Trudeau the governor. There's, I think, better ways to do this. I think the principles are right, and a lot of this makes perfect sense, and I think we should be doing this, should be much more developed. It can really help in terms of the progress we're trying to make in terms of sustainable resources. But I think we have to phrase it better, possibly, to get it done.
Okay. Russia's missile attack, we're also watching this, against Ukraine's power infrastructure on Christmas Day sparked condemnation from world leaders. Russia's today is rebuffing President-elect Trump's call for an immediate ceasefire, but saying it's ready to hold negotiations on a long-lasting peace deal. Over the summer, I traveled to Ukraine's capital and met with President Zelensky for an exclusive sit-down where he detailed the state of the ceasefire talks that have remained elusive so far.
We've had agreements about ceasefire between Ukraine and Russia, and Russia has been always breaking all the agreements and has been killing our people. So only if it's on some international forum in the presence of the countries, leaders who are trusted. They might have different ideas, different views on the stages, how this war will be over, but we all have to be on the same side. We have to trust each other. Trust is very important. The Peace Summit, by the way, has shown that we can follow this plan. Over 100 countries were there, and today we're talking about their nuclear security and energy security, and there will be a clear plan. So the ceasefire also needs a clear plan. We must understand that Russia would not be using ceasefire to simply accumulate equipment on the territory, our territory that they've occupied, because we will not be striking them. I mean, they can use that to create a strong fist here and then accuse us of breaking the ceasefire and start another invasion. So it's really complicated for us. It would take a significant loss for us if they invade again, as in the beginning of 2022, when they had almost reached the capital city. And they accumulated a lot of equipment on the territory of Belarus. And Belarus kept saying that, no, it's just the exercise. No occupation is in mind. It's just the training. It's just military games. It's very important. I really don't want to have this big trouble for my country, because we are at war already. Giving the advantage to Russia now, it's just impossible. We need to be smart, and it's important also who will be responsible for this, besides the Ukrainians who are paying with their lives. Which country will be responsible? It's easy to just talk about ceasefire, but it's very difficult to enforce it, to keep it. It's very difficult to find those who will respond why the ceasefire
But we're going to see
broken.
more calls for a ceasefire, especially as the world politically is moving to the right and potentially moving to the right in the United States. You have said this war is dependent on U.S. aid. I want to ask you, did you watch the presidential debate between Joe Biden and former President Donald Trump?
So, first and foremost, the ceasefire is an important element in any plan to finish the war. So, a ceasefire is not finishing the war. We've been there. It would be just a frozen conflict. And it would be frozen for the aggressor, because it would be frozen on our territory, and our people would be under the occupation. This gives a clear advantage to one side. That's why it's easy to offer different proposals of ceasefires. But what's important? It's important to find answer what would come after. It's the matter of not just the victory. There are many people talking about ceasefire, and it's fine that people are talking, but what would happen next? That is the question. For example, what's the next step? What's the third step? What would be the step when Putin breaks the ceasefire? After the ceasefire, a month after the ceasefire, will he pull out the troops out of Ukraine? Who guarantees that he will pull the troops out of the occupied territories? And there's silence. Nobody has answer. I'm not accusing. I just want to explain that we are at war and we understand this. So, the debates.
Well,
I saw
because
debates.
the answer of how this might all unravel will depend on also who's at the table from the United States.
Amongst other things, it might depend on who is the president of the U.S. Yes, that's a fact. Because the U.S., the United States of America, today are probably the most powerful player. So the matter whether the United States would be the major international player, whether they want that, or they want to focus more on their internal politics. I cannot say, it doesn't depend on me.
So did you watch the debate?
Yes, I watched the debates. So first and foremost, I want to say, I don't know, maybe it would be out of tune to what we see in the US media, but I watched. And we are not electing the president of the US, so I didn't look at the incumbent president and the former president. I looked at them in terms of Ukraine.
President Trump said he'll end the war before he's elected.
Yeah, I heard.
What do you make of that?
Let me be frank. For example, well, the decision is on US public. But let me just have some reasoning. Але для вас це важливо. Yes. So let us imagine that the winner might be Trump in November. And he knows how to end the war. He has a plan. Me, as the president of a country at war, not a theoretical person, but a real-life person, I would like to be prepared. We are 40 million, we're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? Tomorrow, do we want the war to be over tomorrow? The war didn't to start. It was Putin who started it. But I hope you agree that it would be fair. If Trump knows how to end this war, he should tell us today, because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone.
That was part of my interview with Ukraine President Volodymyr Zelensky over the summer. Peter, what do you make of the fact that this is a hot conflict that's going to be passed on from the Biden administration's Trump administration? Trump says he will end the war before he gets into office. That's obviously not going to happen. But what are you and the generals thinking about at Academy?
So I think two things. One is I think Trump does not necessarily back either side. So I don't think he's committed to either side necessarily winning. I think he wants to find some sort of a deal. I think he views himself as the teacher coming into the schoolyard and picking the two kids and telling them, you're going to sit down and figure something out. I think he's going to use a carrot and stick argument with both of them. So there's going to be threats. There's going to be cajoling. I do think the fact that we have these Russian frozen dollar reserves, that will be a big part of Trump's negotiation, how he divvies those back up. Unfortunately, I do think that until this truce occurs or a peace occurs, you're actually going to see an escalation in the conflict because both sides are trying to redefine the borders. Assuming Trump comes in, assuming Trump's going to push them, they want to be in the best negotiating stance possible. And I think that's the sad part of this, is that's why you're seeing the violence increase.
So it's an escalate to de-escalate potentially.
Yeah, I think from both sides. So they want to kind of lock in as much as they can coming into this. And then I think probably both sides realize Ukraine, it's almost, when we go through this from a military standpoint, it's very difficult for Ukraine to win and push the Russians out permanently. It's just a matter of numbers. On the other hand, I think it's quite clear that it's very difficult for Russia to really take over and accomplish everything they wanted. So at some point, both of them must be looking for some way to claim victory and move on.
Potentially Trump offers the off-ramp. All right, that is one story we'll be watching deeply in 2025. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. China's finance and property companies saw their workforces shrink for the first time in recent years. The financial sector lost 32% of its staff, while developers saw a 27% drop, according to data released today. Financial firms have been hit by a widening government crackdown, while the housing market has suffered the worst downturn in China's modern history, pushing developers into default. Meanwhile, Russia has rejected President-elect Trump's call for an immediate ceasefire in Ukraine while showing willingness to hold talks on a long-lasting peace agreement. Russian Foreign Minister Sergei Lavrov saying in a news conference today that a ceasefire is, quote, a road to nowhere. Trump on Sunday had suggested that he's open to meeting his Russian counterpart to discuss ending the war. And Uber's plan to buy Foodpanda's Taiwan business was rejected by the country's antitrust regulator. Uber said it was disappointed by the decision, but plans to continue to invest in Taiwan as one of the world's fastest growing food delivery markets. The deal would have given Uber and Foodpanda a combined market share of over 90%. Uber has not mentioned any plans to appeal the decision. Meanwhile, Japan Airlines was forced to halt ticket sales earlier today and delay flights due to a cyber attack during peak winter travel season. Ticket sales are now back up and running after being halted as a result of the incident. The company said systems have been restored without any leakage of customer data and no damage. This comes after American Airlines suffered a technical glitch Christmas Eve. That's your Bloomberg Brief. Anne-Marie?
Thanks so much, Yahira. Up next, a new chapter for the U.S. and China.
If China or any other country makes us pay a 100 or 200% tariff or tax, we will make them pay a reciprocal tariff or tax of 100 or 200%. China thinks we're a stupid country, a very stupid country. They can't believe that somebody finally got wise to them.
That's coming up next. You're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance this day after Christmas. Thank you so much for joining us. When it comes to the Santa Claus rally, we are seeing a little bit of a pullback. Red across the screen when it comes to S&P 500 futures, also NASDAQ futures. You could see S&P 500 futures there, down nearly 0.4%. We are seeing yields climb higher today. On the 10-year basis, 10-year yield is up 3 basis points now, 4.62%. Seeing a little bit march higher on these yields as we go into year end. Under surveillance this morning, a new chapter for the U.S. and China.
If China or any other country makes us pay a 100 or 200% tariff or tax, we will make them pay a reciprocal tariff or tax of 100 or 200%. We made a fortune on it. Tariffs, properly used, which we will do, and being reciprocal with other nations, but it'll make our country rich. China thinks we're a stupid country, a very stupid country. They can't believe that somebody finally got wise to them.
Here's the latest. Investors bracing for a U.S. China trade war with President-elect Trump pledging massive blanket tariffs on imports from the country beginning as early as Inauguration Day. Shahzad Qazi of China's Beige Book saying the effects may not be so immediate, writing Trump can be convinced by his cabinet principals and must to reconsider an aggressive tariff agenda. And more importantly, the tariff war isn't something investors will truly have to deal with till more or less early 2026. Shahzad joins us now. Shahzad, thank you so much for spending the morning with us. Tell us why potentially we have an entire year left before we start thinking about tariffs.
Yeah, I think this is the market consensus. It's important to point out that they don't, investors have decided that they don't have to worry about tariffs and they don't have to worry about a trade war till more or less 2026. I should caution that I think that's probably not going to be the case. You have the team that's being assembled as we speak, the economic team that's being assembled by the transition that is still very much going to be making sure that the president has what he needs in order to make big, bold pronouncements, threats, and maybe even announce some decisions as soon as he gets into office. So I think markets are going to get rattled by the tariff threat and perhaps the announcement of tariffs, at least by the president himself, far earlier than they currently anticipate.
What kind of fiscal firepower do you think China has to retaliate against what Trump plans on doing?
Well, look, they're trying to conserve as much dry powder as they possibly can. The reality is that if they want to double down and support their industrial sector, which is by the way, what they're gearing towards doing. The latest announcements that they've made about bond sales, at least a third of that is going directly towards supporting the manufacturing sector. They have quite a bit of capacity to continue doing so and making sure that Chinese factories are able to, produce and supply products on the global markets at very competitive prices, even after you account for tariffs. Keep in mind, Chinese products are already incredibly low price right now.
So one of the questions I have for you is, they seem to be addressing the production side. What are they doing to address the demand side? Is that something China's done enough for? Is that something they're going to have to do ultimately?
Yeah, I mean, that's, I think, the second developing consensus right now, that there's going to be sort of this big direct household focused stimulus that we're going to get in 2025. I remain quite skeptical of that. They are not as yet really focusing on sustainably stimulating consumer demand. They've announced more subsidy programs, trade-ins and such. You can pull growth forward. You can get a little bit of a boost. But I think even as we're seeing right now, it's very limited. It's not sustained. But the reality is that we haven't heard, at least as yet, anything out of the Communist Party or any of Chinese officials about large-scale direct household-focused stimulus, which could actually generate or spur domestic consumer demand. So it seems very much like supply side is where their mind's at.
At some point, if the economy continues to remain weak and struggle, does this represent a threat to either Xi or the Communist Party? Is this something they have to really address, or can they let this slide for a period of time?
Well, I think Secretary Xi and the top officials there understand very clearly that China's economy is slowing regardless of what happens. It is absolutely going to continue growing below 5%. Even there are years where they claim it's going to be at 5%. We should be very skeptical of that. So it's not the growth slowdown that scares them as much as they want to make sure that they make China a global manufacturing, or rather industrial superpower. They want to absolutely dominate high-tech manufacturing, and they need to figure out a way to employ their people. It's that picture that they're more concerned about rather than just the top-rate growth. I think a lot of that really is, quite frankly, still the obsession of Wall Street more than Xi or anybody else in China.
You have such great insight into China with your data collection. Can you give us a sense on how strong or weak the Chinese consumer is right now?
I think, what we've seen happen this year is that the Chinese consumer has actually been performing better than expected. And even at times that's been assumed. So, we've seen a split between spending oftentimes on experiences or oftentimes on goods. Now, what we're not getting, of course, is consumers just going out there and spending on everything, of course. So, in the larger scheme of things, consumer spending has been, of course, weak. But, it's not catastrophically so, and it's certainly not in a major crisis situation. And I think more credit could have been given this year to Chinese consumers than they got.
Shahzad, thank you so much for your time today. Shahzad Kazi of China Beige Book. Coming up next on the program, Sarah Hunt of Alpine Sachs & Woods, former State Department spokesperson Morgan Ortagus, and Jason Bazinet of Citi. Peter Cheer, thank you so much for joining me for this hour. What's your one top piece of advice for 2025?
I think be careful of Trump because he does like chaos. And anytime you get complacent, look for the rug pull.
There we go. Look for the rug pull. This morning, S&P 500 futures down more than 0.3%. Another hour of surveillance coming up next. This is Bloomberg.
As far as the stock market, I'd say it's reasonably priced for another decent year.
There's just been a lot more kind of idiosyncratic risk out there. Volatility is kind of a little bit all over the place.
What tends to happen, though, in January is all the sort of market moves that we have in December get completely unwound.
We're going through a nominal regime shift to a higher nominal GDP condition.
We trust the data, but we take it with a grain of salt. We look at a broad measure of every type of indicator.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City for our audience worldwide, good morning. This is Bloomberg Surveillance. John and Lisa are off today. I'm Anne-Marie Hordern, holding down the fort for you this hour with Sarah Hunt of Alpine Saxon Woods. Thank you, Sarah, so much for joining me this morning. Merry Christmas and happy holidays to you and your family. We have this Santa rally having a little bit of a halt. Not actually going on the day after Christmas this morning. S&P 500 futures down more than 0.3% this morning. How difficult is this moment to price equity markets between this weird week between Christmas and New Year's?
I think it's difficult, but I also think that you have some ancillary information that we got both from the Fed meeting and then from the CR fight, which is how fast are we going to get some of the things that we thought we were going to get into 2025? And I think that took a little bit of the wind out of the sails, both the Fed being more hawkish and then the concern about whether or not things can actually get done. So I think that just makes what was going to be a challenging year to parse anyway even more challenging.
Yes, definitely is going to be a challenging year. If you think about how people were thinking about 2024 and how the year ended up shaping out, especially when you think of things like Fed rate cuts, didn't exactly pan out to how investors were looking.
No, people were expecting far more rate cuts. The beginning of the year had the data that made people realize that those rate cuts might not come as fast. We finally got some in September. And I think that the expectations have not been correct. So when people get worried about changing those expectations, in the end, they've been wrong for the last 2 years. So I think we're going to have to see, really, we got some good PCE data after the Fed meeting that was at least slightly on the weaker side. And I think that helps. So it's really going to be a scrutiny of each data point as they come out. And people are going to be looking to how that works in with what the Fed's sort of mindset is.
Well, we do get one data point today, 8:30 a.m. Eastern Time. We will have jobless claims. This is what our survey is looking for. 223,000 claims are penciled in. Of course, claims data does fluctuate around the holidays. As we've been saying, the Santa rally, that really isn't so much, not so merry this morning. S&P 500 futures clawing back some of those gains we made on Tuesday, down 0.3%, but still, the S&P 500 closed up higher on Tuesday, which extended this year's rally to 27%. Euro dollar this morning, bang on 104. We started the year around 110. The dollar's just been on a tear, and things have been very difficult when it comes to the Eurozone. 10-year yield, we do have yields climbing this morning, up 3.4 basis points. You have a 10-year yield of 4.62%. And then crude, a little bit firmer as well this morning at $70 for New York crude. Coming up this hour, former State Department spokesperson Morgan Ortagus, with tensions in the Middle East continuing through the holidays. Jason Bazinet of Citi on Netflix's first foray into football, and highlights from David Gurr's interview with U.S. Treasury Secretary Janet Yellen. We begin this hour, though, with stocks on track for their third straight year of gains, even though we do have futures clawing back a little bit. Sarah Hunt says we expect some potential volatility at the start of the year, but also see a reasonably good trajectory for the economy and therefore earnings, at least in the United States. Can some of the measures discussed, such as tariffs and deportations, have an inflationary effect? It is certainly possible, but the timing of that is not clear. If the underlying strength in spending can be maintained and earnings can grow as projected, it may not be a lump of coal being delivered in 2025. Sarah is still with us for the entire hour. Sarah, thank you so much. So how difficult at this moment is it to think about 2025?
Well, you have a lot of uncertainty. Besides the fact that we've got a new administration and a new Congress, there are, again, questions about what parts of the agenda are going to be implemented when, what are the abilities for some of the good things that markets are expecting and investors are expecting to happen, the timing on those. I think that it's just going to be a challenge as we get through the beginning of it to see where things are going to shake out and when. And I think that, the good news on equity markets is that you have the quantum computing story to add to the AI story. So that's added a layer of story, and equity markets like stories, especially in the U.S. So I think that is good news, but you're going to have to continue to see earnings come through. We're not trading at a low level on markets or a low PE multiple. So if you don't see the earnings and the earnings growth coming through, I think that's going to cause markets to struggle a little bit too. But we expect to see some earnings growth come through.
Are markets potentially pulling back now because all these questions they have going into 2025, all the good stuff you mentioned about Trump is already baked in?
I think it's a combination of that and a combination of the fact that things got very lofty. I mean, you look at some of the charts and you see that there were some really strong moves. And even if multiples come down a little bit for a lot of stocks, they're still going to be expensive. So I think it was a combination of, well, maybe we're not going to get what we want as quickly as we want it, but also we did have quite a big move towards the end of the year in November. So I think that December's a little bit got pulled forward into November, and so that some of that movement higher in the market that happened in November is leaving December a little slower.
Everyone was talking about the end of 2025, broadening out, especially around the Trump trade. Do you actually think 2025 we could see a broadening out in equity markets?
You have to see the economy do well. And for the economy to do well, you have to, interest rates are a part of that. The expectation on interest rates is a part of that. But the truth of the matter is you just need to see decent economic statistics for that to broaden out. Because broadening out really means that the mid and the small cap stocks are going to start to do better. And it's not just the giant tech companies that are continuing to do well. And you really need a good economic backdrop for that. It's pretty benign at the moment. If it stays that way, I think that you will see some of that growth. But you have to see that coming from those smaller stocks for that to work.
How much of an uphill climb is that, though, when you have yields rising? Even the yields this morning are on the march.
It is a challenge. It sort of depends. I mean, this comes back to where our balance sheets, right? So if I think about what broadening out means, it also means for us, the smaller and mid-cap stocks with good balance sheets and good cash flow. If you don't have that, then yes, rates are more of an issue. But we've had rates at these levels or higher levels for a couple of years, and it hasn't really shaken out as much as people might have expected it to. So it really depends on where you sit in how your balance sheet looks. And I think that if you've got a decent balance sheet, and then you should be able to see some growth, and those higher yields are less of an issue for you.
You mentioned things like quantum computing and AI. Is basically one piece of advice to investors: ignore everything that goes on in Washington, D.C., and just focus on these two stories? Can you make money just doing that?
Well, so far you've been able to make money just doing that, but there's been a lot of volatility in there too, and I think that that's part of the volatility will continue in that group as people as it waxes and wanes. But the upside on the AI trade has been that other companies, besides technology companies, have started talking about how they're benefiting. That's an important piece to that story. Had that not been the case, I think you would have seen more volatility this year. But that gives you an earnings push for other companies outside the technology space, and that also means the adoption is going to continue and the spending is going to continue, because that's really what drives a lot of this. So you can ignore some of the things, but from a sector perspective, there will be other parts of what happens in Washington is going to make a difference. But right now, the technology sector is sort of in its own world, and that is driving a positive effect for the equity market.
A sector you've liked this year that definitely is going to take cues from Washington, D.C. is energy. Mm-hmm. Are you still liking the energy space?
I think that the energy space, what people are starting to realize, it hasn't necessarily come through in a lot of the stocks, although you've seen the pipeline certainly have a move higher, is that the legacy hydrocarbon usage is not going to go away as fast as people expected. And therefore, you're going to see a lot more investment in that industry where people thought it was a dying industry. And I don't think that that's the case. The question really is, how well can companies benefit from that? And like I said, the pipelines are seeing it because those are assets that are very difficult to replicate. But you're still going to see, as natural gas prices rise in Europe, the LNG trade and other parts of that do well in the U.S. And I think that that's something that is going to become, again, more interesting. You've also got decent yields in that, and the multiples are not as challenging as in other sectors.
And do you think an ushering in of the Trump administration means more deregulation, means there's room for these companies to grow and expand?
I think it's less likely that they're going to face problems that they would have faced potentially otherwise, and some of the issues. Whether or not that can really be pulled out to a longer and better trajectory remains to be seen. But certainly I think that some of the challenges are going to be less problematic, because I think this is an administration that feels more strongly about the older energy situation than some others.
What other sectors do you like going into next year?
I think that some of the industrials look good, but there's some expensive stocks in that sector as well. I think that you are looking at some of the areas that that are not participating, right? So staples have come down a lot. So that's an area that could be interesting because the cash flows are there, but the growth isn't enormous. I think that some of the consumer stuff may be under pressure this year. It depends on, again, let's see what happens with wages and employment. I think a lot of the questions on the economy are going to be, where do people spend? And right now, there's still a lot of spending in experiences. So that area is still doing pretty well. You look at some of the travel companies like Booking, and you look at some of those, and those stocks are continuing to do well. So there are areas that we think are going to continue. I think you have to be a little bit careful in consumer discretionary, and I think that there are some opportunities, like I said, in places that are underloved, like energy and materials, that are more looking at the world as if it's not going to grow as much as some of the other sectors.
When it comes to all of these companies, how do you think tariffs are going to impact them, especially consumer discretionary?
I think the question is it going to be a bludgeon? Is it going to be a soft tap? We don't know yet what's going to start from the beginning. We've heard a lot of things bandied about in terms of levels and everything else. I think it does matter how high those levels are. If they're punitive, you're going to see some problems in the spending there. But if it's something that's more of a stick and not a carrot, then I think that that's less of a problem. It really is going to depend on how fast they're implemented, what levels they're implemented at, and what the trade-offs may be to get them reduced if it comes in at a high level. If people think that it's going to be high and stay there, it could be problematic for spending.
Sarah Hunt, you're going to be sticking with us throughout the hour. Thank you so much for joining us. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackes. Hey, Yahira.
Hi, Anne-Marie. China's parliament ousted 2 military lawmakers without explanation, citing suspected violations of law and discipline. The move is seen as part of an ongoing anti-corruption campaign in the military, which has been in full effect since last summer. President Xi Jinping has focused efforts on consolidating his power over the military, which has included a reorganization of the armed forces and the replacement of senior officials. Meanwhile, Uber's plan to buy Foodpanda's Taiwan business was rejected by the country's antitrust regulator. Uber said it was disappointed by the decision, but plans to continue to invest in Taiwan as one of the world's fastest growing food delivery markets. The deal would have given Uber and Foodpanda a combined market share of over 90%. Uber has not mentioned any plans to appeal the decision. And a dead body was found in the wheel well of a United Airlines aircraft, according to the New York Times. The death is under investigation, and the person has not been identified, according to the local police department. The flight departed Chicago on Tuesday morning and landed in Maui, Hawaii, in the afternoon local time. That's Bloomberg Brief. Anne-Marie?
Thank you so much, Yahira. Up next, outlook for the Middle East.
I'm optimistic that there are more opportunities for regional players to improve the Middle East with Iran's, the collapse of Iran's axis of resistance. We need a strong team in the United States to provide assistance and guidance.
A lot of red lines were evaporated in the Middle East this year. That conversation coming up next with Morgan Ortagus. You're watching Bloomberg Surveillance. Good morning and welcome to Bloomberg Surveillance. Happy holidays and Merry Christmas if you are joining us this morning. The Santa rally is halted this morning. We should note S&P 500 futures are a little bit lower today. Alongside as well, we do have the 10-year Treasury yield climbing. It's up 4 basis points now, 4.63%. And euro dollar now dipping below 104. We've seen the dollar on a tear and absolutely euro just crumble throughout this year. It started off 2025 hovering around 110. Now it's at 103.95. And New York crude this morning, $70.42, just a touch firmer on crude this morning, up nearly 0.5%. Under surveillance this morning, the outlook for the Middle East.
I'm optimistic that there are more opportunities for regional players to improve the Middle East with Iran's, the collapse of Iran's axis of resistance. At the same time, this requires an international effort to support those players. We need a strong team in the United States to provide assistance and guidance without pulling ourselves into this mess.
Here's the latest. Uncertainty in the Middle East adding to global geopolitical risk between the ongoing Israeli-Palestinian conflict, Iranian proxies, and Russia's growing influence in the region. Former U.S. State Department spokesperson Morgan Ortagus writing, quote, President Trump will deliver peace once again in the Middle East because he knows how to use both carrots and sticks to achieve outcomes. Morgan joins us now. Morgan, happy holidays to you and your family. Thank you so much for joining us this morning. I want to pick up what's going on in Israel. We had yesterday Benjamin Netanyahu's office coming out and saying that Hamas was basically backtracking on some of the promises they agreed to upon as they try to have this ceasefire hostage agreement. The two sides still are talking, though, and we did have representatives from Israel in Qatar. Do you think we will see an agreement before President Trump's inauguration on January 20th?
Well, we need to, and I think both President Biden and now President-elect Trump Trump, both of their teams are working pretty aggressively on this to see this happen. You've seen President Trump make statements that the hostages better be returned or else. And by the way, that goes back to his convention speech last December when he brought up the hostages. When you look at the Middle East writ large, first of all, there's almost always geopolitical risk there. Anytime I'm going around the world and doing geopolitical risk conversations, I never skip over the Middle East. So you always have to factor that in. But whether you're looking to a possible peace agreement between Saudi and Israel, or whether you're looking at how in the world the U.S. helps influence Syria, none of these pieces on the chess table move until you get the hostages home, until you get a ceasefire in Gaza. That's sort of the catalyst for anything else happening.
We have seen Steve Witkoff, who Trump has named as one of his envoys coming in, actually go into the region. Do you see a peaceful transfer in terms of relationships between the Biden administration and incoming Trump officials?
I do. I think Jake Sullivan and Brett McGurk, listen, I've known Brett since my Iraq days, I think back in 2007. But Brett worked actually in the first Trump administration. So I think when you look at Jake Sullivan, Brett McGurk, Mike Waltz, of course, the incoming national security advisor, and Steve Witkoff, it does appear that the four of them are working and coordinating quite closely together. Because listen, nothing is more important to either administration than getting these three remaining Americans who we believe still to be alive, getting them home. And of course, you want the bodies of Americans as well. So I think that's one of the areas that you could see bipartisan consensus and you can see people working together. Of course, I also think that Saudi and Israel is a high priority for both administrations to get some recognition and to get a peace deal there. And I think the reason that it's so important, as we've seen Iran's proxy empire sort of falling apart around the Middle East, there's going to be vacuums. We see Turkey trying to fill the vacuum in Syria, for example. So as Iran's proxy empire decreases and lessens, you really need Saudi Arabia and Israel to sort of stand up and fill in that vacuum as well.
That was going to be a question that I had, which is there's an opportunity here, but then there's also some concern that it could get worse instead of better, or worse before it gets better. And how do we know who the players are and who the real power is behind the curtain at the moment, because there's so much chaos in front of the curtain? Do you feel like there's a strong ability to understand who the better outcomes might be?
Yeah, it's always hard, right? You make such a great point, because we all cheered whenever Assad, escaped to Russia, whenever his regime fell because of the civil war and the hundreds of thousands of his own people that he massacred. But as true with the Middle East, the minute Assad is gone, you start looking at HTS and others and thinking, oh, well, maybe we didn't actually want former al-Qaeda elements governing the country as well. I'll tell you one thing that I think that we have to keep our eye on the ball. The one piece of sort of Iran's proxy empire that still remains vigilant and active is the Houthis in Yemen. Of course, in the Trump administration, we designated them an FTO, a foreign terrorist organization. That designation was removed. Later, a lesser designation, an SDGT, was given by the Biden regime. When you look at the Houthis, they have been able to completely disrupt commercial and international trade in the region. We've seen them directly go after U.S. Navy ships. We've seen ballistic missiles, advanced drones. By the way, we've seen some of them go all the way from Yemen to Israel, where they tried to hit U.S. diplomatic facilities in Israel. And of course, they continue to try to attack Israel as well. We see that. And to me, that is one thing that I think is when you look at action in the region, what's most eminent is between Israel and the United States and the larger free world. You cannot continue to have a terrorist organization that shoots ballistic missiles, drones and sophisticated weapons, and completely disrupts international trade. I mean, it's untenable that it's gone on since October 7th. It has to be stopped. You're seeing more Israel and U.S. strikes. I think that that's going to have to be ramped up pretty significantly. And it's sort of a shame in the second term of the Obama administration that we told Saudi and UAE to take their foot off the gas as it relates to the Houthis, because now they've developed into one of the more sophisticated proxies that Iran possesses.
When it comes to Iran and the incoming Trump administration, do you think Trump is willing to do a deal with Iran, or is it going to go back to immediately maximum pressure campaign?
Great question. President Trump said unequivocally in his first term that Iran would not obtain a nuclear weapon on his watch. He will have to clarify if that's still his policy for his second term. I assume it will be, but it's in a much different place than it was 4 years ago. So 4 years ago, the regime was starved to cash. We now know because of lax enforcement of sanctions. You know, the max economic pressure sanctions, they're still on the books. They just haven't been enforced. So I think coming back into this new term, the Trump team can go back into, it's not even actually going back into max pressure again because those sanctions are still there. It's just enforcing the sanctions that are on the books. However, that is sort of like putting a genie back in the bottle. This was a massive diplomatic effort for us in the first term to get China and India, Japan. I mean, you can go around the world to get these countries to stop buying Iranian oil. So enforcing those sanctions means, you know, it's a lot of heavy diplomatic work. I do think that the Trump administration will likely, again, enforce the sanctions that are on the books. President Trump will have to look at a very difficult situation where Iran is, I mean, they're basically at breakout now. Oh, and by the way, the JCPOA is essentially expiring in 2025. So this is a deal that we have, the collective Republicans and Democrats in Washington, we've been arguing about for, you know, a decade now since President Obama worked on this. Most of the sunset provisions are there. There are things that Elise Stefanik could do at the UN if she is confirmed as UN ambassador related to snapback sanctions. So there's certainly mechanisms at the UN and the E3, the United States, Britain, Germany, France, that we could work on together as it relates to Iran sanctions. But 2025 is going to be a very difficult year for the Iran portfolio because of those major provisions sunsetting in the JCPOA. So what comes next? That's the $1 million question, or maybe the $1 billion question.
Well, and that also goes to the question, or goes to the problem of the Houthis, right? Because part of it is funding, and if that if you can stop the funding there, or at least cut that funding off, the question really is how many assets do they have, and what's that time frame in between? Because if we do start to get some stronger sanctions, is there then too much already money there, and that continues to let them be problematic? I mean, I do think that that's a big issue, not just for the U.S., but for everybody, because that trade route and that oil route is very important for the entire world. That might help get other people on board, but it's a little bit hard to tell at this point because there's so much going on.
Yeah, when you look at the effectiveness of sanctions, and this is an argument I know that you've had many times on your show, I started at Treasury, I think back in 2008, working on sanctions, and we know that sanctions are never meant to be, the whole piece of the whole pie, I should say, just a piece of the pie. So when you look at the Houthis, if we start implementing sanctions on Iran, again, that are on the books, will that help us be able to, decimate or downgrade, I should say, part of Iran's ability to fund these terror organizations? Don't forget we have the Shia militias in Iraq as well. That will certainly help. But now, the Houthis in many ways have a vast network. So you're going to have to look at. We don't really have a U.S. Diplomatic presence there. The U.S. military would like to focus on China. You look at incoming Undersecretary for Policy at the Defense Department, Bridge Colby. He's been, yelling for 4 years on Twitter that we need to reprioritize and focus on Asia. But if you have a terrorist group shooting ballistic missiles at your new U.S. Navy ships in another theater, that means we're constantly using other resources to try and degrade the Houthis. That means you're sending more ships. That means you're using more of our TLAM supply, things that we would be using theoretically in a China fight. So it's not going to be easy to downgrade the Houthis. We're going to have to certainly work with regional partners, and that probably means getting the Gulf countries to deal with the Houthis once again, in addition to the Israelis. So that's really where we're going to see a lot of regional coordination.
We're going to have to leave it there, Morgan. Thank you so much for joining us. Morgan Ortagus. This is Surveillance. Welcome to Bloomberg Surveillance. The day after Christmas, a viewer does write in instead of a Santa Claus rally, it's a Santa Pause rally. Ha ha ha. This is what we're seeing across the boards this morning. Futures are lower. You're seeing red on the screen across the board. S&P 500 futures down 0.3%. The volumes, you have to imagine, are light. Most people are at home, still enjoying the holidays with their families like John and Lisa, unlike me, that is dedicated to my job and here at the office. What we're seeing across assets this morning, yields are climbing this morning, actually. We do have the 10-year yield now up more than 3 basis points, 4.62%. You have a lot of big calls for next year when it comes to what's going on in the Treasury market. Everyone is saying yields potentially, we're going to have to live it higher for longer when it comes to the Fed, but also the fact that potentially we could see a 10-year yield, according to T. Rowe Price, as high as 5%, even maybe 6%. And at some point, does that start to push back on some of these potential hopeful Trump policies that the incoming administration want to enact? Also, note for your calendar today in your diary, jobless claims will be coming out at 8:30. Our survey has 223,000 claims penciled in. We should note data around the holidays, they tend to fluctuate. And what's going on in terms of the currency space, euro dollar, it is getting a lot cheaper to go to Europe these days if you're an American. Just below 104 this morning. Came into the year and this currency pair was around 110. It has been a rough road for the Eurozone. Under surveillance this morning, and maybe it's going to get rougher, President-elect Donald Trump naming Kevin Marino Cabrera to serve as U.S. ambassador to Panama. Cabrera serves as a district commissioner of Miami-Dade County and worked for the Trump campaign in 2020. The announcement following Trump's call for the U.S. to regain control of the Panama Canal. So, Sarah, he keeps coming out with these grievances. I think President Trump thinks it's Festivus. Grievances when it comes to Panama, Greenland, Canada, Mexico, and China. All these stories, though, have one common theme, which actually is China and China's growing influence, especially in a place like Panama. What do you make of all this as you're trying to decipher what matters in terms of policy for 2025?
Well, I think, if you go back to his first term, there are some of these things that have been brought up originally then as well. And I think that what it says is a little bit more of an outward-looking U.S., like we're looking at these areas that could be influenced and we're saying we don't want that influence there. Whether or not that's helpful or hurtful remains to be seen, because does that drive people away further from the U.S. or does it make them say, okay, the U.S. is now paying attention and we need to figure out how to coexist in a more friendly way? I think that we don't know the answers to those questions yet, and I think really that's going to depend on a variety of different things. But even talking about the strategic usefulness of some of those areas is different than what we've been living with for the last 4 years. So I think that those differences are going to have to eventually square themselves, but we don't know yet. Right now, it's a lot of discussion.
One area, one sector that's preparing for the walls going up and tariffs is going to be the auto sector. And according to estimates this morning from the Financial Times, China's electric vehicle sales are expected to exceed traditional car sales in the country for the first time next year. Meanwhile, sales of internal combustion engine cars are expected to fall by more than 10%. And we are very lucky to have Sarah this morning because you just got back from China. And you said you saw BYDs everywhere. Are they pervasive now in the Chinese economy?
I would say, so you have different colored license plates for EV cars versus regular cars. They're green versus blue, and I saw a lot of green license plates. Many of them were on BYD cars, which stands for Build Your Dreams, which I did not know until I went to China. And I would also say that there's an encouragement, there are factors encouraging EV purchases, which are you can drive more regularly. With ICE, you have to drive every other day as opposed to you can drive any day. And the tags, the cost of the tags for your car are much more expensive. If it's an EV, you can get a tag. If it's a non-EV, it's expensive to get a tag. So there's clearly incentives pushing towards the EV side. It is unclear to me exactly where everyone's charging those cars because those cities are very densely built, and I did not see a lot of charging stations. Apparently there are a lot of basement charging stations, but that is, I think, one of the issues for such a big place, which is how am I going to charge all these cars? But there's definitely incentives pushing people into electric vehicles.
How much faster is China moving? These EV sales is set to overtake traditional cars years ahead of what the United States or Europe with the West is trying to achieve.
Well, I think in a lot of cases, when you look at an accelerated build out, like their highway system and even people owning automobiles, right? Like let's look back at the history. It was not, the auto sales have been much higher in the last decade or two than they had been historically. So I think that you are in a position where you've accelerated a lot of that. And if you are going to incentivize, to the extent that they're incentivizing it, to own an EV, there's really also a question of what is the level of sales versus the level of sales in the last few years. But I think it's not a surprise because those incentives are so strong to be in EV vehicles.
Also, a BYD car is as low as $10,000 you can get one for. All right, from autos to airlines, Japan Airlines was forced to halt ticket sales and delay flights due to a cyber attack this morning. Ticket sales are back up and running after being halted as a result of the incident. The company said systems have been restored without any leakage of customer data and there is no virus damage. This, of course, comes after American Airlines experienced a brief ground stop on all U.S. flights on Christmas Eve due to a technical issue it blamed on a third-party vendor. I think we just need to get more used to this.
I think, unfortunately, it's one of the reasons that people have been going into and continuing to stay in security stocks is that there are so many vulnerabilities because a lot of these systems are older. And in some cases, there are many systems that are working together for larger airlines. And I think the vulnerability of that is becoming more clear when things like this happen. Because as soon as I heard the Japan Airlines, I thought of the American Airlines issue that happened the other day because, of course, we all heard about that because it was such a big travel day. So I think that there is definitely a need for people to be looking at this on a more regular basis.
Nothing says Christmas like flight delays. Ukraine's war against Russia sees no sign of stopping anytime soon, something we'll be tracking going into 2025, with Russia launching a large-scale missile attack on Ukraine's energy infrastructure yesterday. Bloomberg's David Gura sat down with U.S. Treasury Secretary Janet Yellen earlier this month and asked her about the future U.S. sanctions against Russia.
We never preview sanctions, and we've constantly been tightening our sanctions on Russia. Our overall aim is to impair Russia's ability to continue conducting this brutal war, to try to deny it the military equipment. It needs to be able to do that, and we've taken a variety of steps to do it. But we have been focused since the outset on Russian oil revenue. It's a critical component of the Russian budget. And we've been looking for creative ways to try to reduce Russia's revenue. One of the most creative policymaking things that I've been involved at during my career occurred here in Treasury when we were able to devise a way and convince our allies to join us in this, imposing a price cap on Russian oil, which was a way of avoiding price spikes when the war started for oil, and actually succeeded in keeping Russian oil flowing into the market. So we continue to look, of course, over time. While these sanctions have been effective, Russia has invested a lot, its own fleet of ships to carry its own oil. We cut it off from allied ships, new insurance that have been costly to Russia to have to make those investments. Now, what's unusual about this moment is that the oil market seems to be well supplied.
Prices are relatively cheap.
Prices are relatively low. Global demand is down. And there really has been an increase in supply. American firms have stepped up. We have vastly expanded oil production. OPEC countries like Saudi Arabia have excess capacity at this time. So the global oil market is softer, and that creates possibly an opportunity to take some further action. We're looking at it.
You talked about creative policymaking, and so vis-a-vis Ukraine, there was a moment this week when you dispersed $20 billion to Ukraine alone, and that'll be paid for with interest on frozen Russian assets. So another creative piece of policymaking that you've been involved with. We're at this moment where I think there are a lot of questions about what policies can remain in place. And I wonder, when you look at that in particular, are you confident that under a new administration, that program can continue in perpetuity?
Well, we have worked with, if you're talking about the so-called ERA loans, extraordinary acceleration loans, we've now transferred $20 billion, which is the United States contribution to this loan package. to the World Bank, to a financial intermediary fund that was set up to channel these monies over time in coordination with our allies to Ukraine as it's needed. So, and as you mentioned, importantly, this is not using U.S. taxpayer resources. These loans will be paid off over time by the extraordinary or windfall revenues that are being earned in Europe at Euroclear on the Russian assets that are being frozen there. So Russia is really helping with this to pay Ukraine to, help it fight the war. So I feel confident that this is something that can stay in place. And what we're really trying to do is to strengthen Ukraine's situation, its ability to defend itself, and hopefully at some point to come to the table to bargain with Russia for a just peace. We want to strengthen its ability to have the equipment it needs, to have the money it needs to, continue to finance schooling and emergency services to its people, and to put it in the best possible situation to support a lasting and just peace.
Bloomberg's David Gura speaking with U.S. Treasury Secretary Janet Yellen. Part of that conversation was about maybe more sanctions on Russian crude. And I and some of my colleagues down in D.C. had this reporting that before Biden leaves office, they might actually go after Russian crude outright, not going through the price cap. Do you think any of this could be, a premium added to the oil prices?
I think anything where people start talking about getting more serious about it can have a short-term effect. But I think what we've found collectively is that oil is a fungible good. So you can put restrictions in different places, but the fact is it tends to move anyway because it's a very high value cargo, right? So I think if there is a stricter regime about it, you might see a move in the price in the short term, but you've also got OPEC basically holding back a little production because there hasn't been that much of a shortage that people were looking for because of the combination of sanctions and because people thought that demand was going to be higher. So you've got a little bit of a tension that's going on there. So I don't know that that would necessarily be sustainable. I think you need a higher demand picture before that happens.
Right, there's a ton of spare capacity. I think Saudi Arabia, UAE would be excited to start filling some of those gaps. All right, let's get you an update on other stories we're watching elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. Turkey lowering interest rates for the first time in almost 2 years by 250 basis points after consumer inflation showed some signs of easing. The central bank's decision was unexpected by some analysts who were divided on the size of the cut or didn't expect one until next year. Medium forecasts in a Bloomberg survey of analysts saw a cut of 175 basis points. Meanwhile, shares of Toyota rallied for their biggest two-day advance since August. Analysts expect the carmaker to post higher return on equity following a report that the firm is planning to double its target. The stock gained 6% in Tokyo after a double-digit two-day climb. And Kansas City celebrating Christmas this year by locking up the AFC's top playoff seed. Star quarterback Patrick Mahomes threw 3 touchdown passes to score a 29-10 victory over the Pittsburgh Steelers. Meanwhile, Coach Andy Reid stunned the locker room with a Santa outfit to celebrate their Christmas win. That's your Bloomberg Brief. Anne-Marie?
Yahira, you and I should have celebrated surveillance this morning with Santa Claus outfits. Get this when it comes to the NFL and Netflix. The Atlantic just putting this out. After Netflix agreed to pay $150 million to broadcast 2 NFL games on Christmas, that's $50 million more than producing a season of Game of Thrones for 2 games. And that's what we're going to be talking about next, Netflix push for streaming dominance.
Let's start with, looking into 2025, we're feeling really good about the business. We had a plan to re-accelerate growth, and we delivered on that plan.
That's coming up next. You're watching Bloomberg Surveillance. Good morning and welcome to Bloomberg Surveillance. On this holiday week, I'm Amber Herdern. John and Lisa are still off. What we're seeing across equity markets today, futures are softer. Santa Paws rally. I love how a guest wrote that in. Santa Paws rally, not the Santa Claus rally. Although we still have a few days left for the rest of the year, so potentially it can turn around. And still, the S&P 500 is up more than 20% on the year. Eurodollar this morning, 103. Yields, though, are climbing, now up 4 basis points. 10-year yield, 4.62%. And New York crude a little bit firmer, $70.52. Under surveillance this morning, Netflix push for streaming dominance.
Let's start with, looking into 2025, we're feeling really good about the business. We had a plan to reaccelerate growth, and we've delivered on that plan. You can see that in our 2024 financials. We expect to deliver 15% revenue growth and 6 percentage points of operating margin improvement. And engagement, which we view as our best proxy for member happiness, because when people watch more, they stick around longer, so that's retention.
Here's the latest Netflix Christmas Day NFL debut going off without a glitch, highlighted by a Beyoncé star-studded halftime performance. Jason Bazinet of Citi has a neutral rating on Netflix, noting, quote, ad tier optimism seems priced in. Jason joins us now. So Jason, they did pretty well when it comes to the NFL yesterday. No massive glitches, even though I heard the games weren't that exciting. Beyoncé, though, got everyone very excited. Do you think we're going to see more of this style from Netflix, diving deeper into live events?
Oh, 100%. I'll just give you some simple metrics just to sort of frame it for your viewers. Netflix, the consumer pays about 0.5 cents a minute to watch Netflix today. On the old legacy linear side, you pay about a penny a minute. And just the advertising revenue Netflix is going to generate off these games is probably a penny a minute. And if I go to something like the Super Bowl, you generate 2 cents a minute of ad revenue. So what they're doing is sort of moving up the value chain in terms of where consumers derive more utility, and they'll keep moving in this direction.
So Jason, why do you have a neutral rating on it?
Oh my gosh, this stock is up almost 100% this year, and I know, can explain
90%. It's unbelievable.
90%. I can explain about half of it. So they had upward earnings revisions that were worth about 20% this year. The street also rolled forward from 25 to 26 estimates. That's reasonable. That's worth another 25%. The balance, that other sort of 40-ish%, I can't explain. There's nothing fundamental in the results that have transpired that warrant that sort of multiple expansion. So the street, if you talk to the buy side, they were sort of penciling in 25 times EPS. Now they're at 30 times on 26 numbers. You know, could the multiple go to 35 times or 40 times? Sure, it could. But we're just not seeing anything that is fundamentally that different that would warrant a higher multiple other than just market euphoria.
Is this one of those situations where the moat aspect of what Netflix does, as in we've sort of taken this piece and we are now dominant in the space, people are paying for the exclusivity that Netflix is? Because we look at multiples across a variety of areas, and you think that there's some real strength in those. And even if they came down a few turns, they still wouldn't be cheap. But I think as some of these giant tech guys get bigger, they become, I'm the one in the space, right? So you see that a little bit with Booking, you see it with Amazon. So is it just, I'm just paying for that exclusivity, and right now mega cap tech is winning, versus there's something specific going on with Netflix, and you know they're cash generative when they weren't for a long time, and there's growth there. But it does seem a little outsized relative to the actual fundamentals.
Yeah, I mean, the buy side does have this winner take most in a lot of these tech names, and that's certainly affecting Netflix's multiple. The thing that is a little bit strange to me is that that was true in 21, 22, 23, 24. It'll still be true in 25, but nothing has fundamentally widened the gap between Netflix as the leader and the rest of the industry. If anything, I would argue that a lot of their streaming peers have actually begun to turn the corner and have started generating profits, not of the quantum that Netflix has, but if anything, the gap has tightened a bit.
Well, when you see things like YouTube raising their prices, and you see areas where it's becoming more expensive to have these, you know, we're going to liberate ourselves from cable and it will be cheaper. And now all the individual pieces are getting more expensive again. So does that maybe put Netflix in a better space, just because if people start to pare things down, it's not necessarily going to be the first thing to go, and or watching rivals up their prices and up them dramatically, does that help them when they're upping their prices as they go along? Because the switch was different and the password sharing deletions were different, and now you've got other areas where they can raise their prices.
Yeah, that's 100% true. So if you talk to the bulls on the stock, they would say, look, Netflix is still cheap relative to linear. We talked about the half a cent a minute versus the penny a minute for linear TV. So that's undeniably true. The bulls also say, hey, look at all the other streamers. They've raised their prices. So Netflix should raise their prices as well. If you ask management about either of those two prongs, they just frown and shake their head and say, no, that's not how we look at it. Netflix looks at it in terms of what you just played in your clip, engagement. If the engagement is up, they feel like they've earned the right to raise prices. And so that's why they're pushing into sports is their engagement levels, their share of streaming has really been flat over the last 18 months, even as the quantum of content spend continues to go up. So what is this? What is sports designed to do? It's to pursue a different vector where maybe the content cost per hour is more expensive, but the consumer response in terms of engagement will be much deeper.
It is more expensive. The Athletic posted this, Jason. Netflix agreed to pay $150 million to broadcast 2 NFL games on Christmas. $50 million more than producing a season of Game of Thrones for just 2 games. Is that worth the money?
It is worth the money. It's because consumers value sports much more than they value scripted or unscripted content. I used to go on TV years ago and this is when the pay TV bills were rising and the common narrative was, oh, it's sports' fault. It's ESPN's fault. That's why the consumer bill keeps going up. And I would always say, no, you have it exactly backwards. The thing that's underpriced in the old linear bundle was sports wasn't expensive enough. It was sports that sort of caused the consumer to pay the $100 a month for pay TV. It wasn't all of the other stuff. And so our preferred way to sort of think about Netflix's push into sports is not to buy Netflix. It's to buy the actual sports leagues that you can buy. That's where the value is actually going to accrue. The value of sports rights will continue to go up.
Jason, thank you so much for your time this morning. Merry Christmas and happy holidays to you and your family. Jason Bazinet of Citi. Stunning year when it comes to Netflix, Sarah. I'm absolutely just struck by this factoid that we basically could have produced another season of Game of Thrones and had money left over. As we end out the hour, though, we'll love to get your thoughts for piece of advice going into 2025.
I think just be braced for some volatility and understand that the markets, you've had 2 great years of equity performance, and that you are going to see some volatility, and that is not the end of the world. We sort of need a little bit of some type of moderation on the valuation front before people get really excited. But at the same time, there's still some good growth, and there's still some real performance to be had out of equities eventually. But don't be afraid if you start to see a little bit of wonkiness.
Sounds like glass half full going into 2025. Sarah Hunt, thank you so much for joining us this hour. Coming up in the program, Jay Pulaski of TBW, Andrew Obin of Bank of America, and Joe Brusuelas of RSM, and Chen Zhao of Redfin. You're watching Bloomberg Surveillance on this shortened holiday week. Thank you so much for spending your morning with us. 1 more hour of Bloomberg Surveillance, including jobless claims, coming up at 8:30.
As far as the stock market, I'd say it's reasonably priced for another decent year.
There's just been a lot more kind of idiosyncratic risk out there. Volatility is kind of a little bit all over the place.
What tends to happen, though, in January is all the sort of market moves that we have in December get completely unwound.
We're going through a nominal regime shift to a higher nominal GDP condition.
We trust the data, but we take it with a grain of salt. We look at a broad measure of every type of indicator.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning and welcome to Bloomberg Surveillance, the final week of 2024, the day after Christmas. Thank you so much for spending it with me. Anne-Marie Hordern, John, and Lisa are still off. Joining me this hour is Jay Pulaski of TPW Advisory. Jay, you've been with us on some big moments of 2024. As we round out this year, what do you make of all of it?
Well, it's been a great year for an investor, right? I mean, the S&P up 25, 28%. So who can complain, right? And now we are changing governments. We are starting to look abroad. I mean, our view is that we're early in what we call the long cycle. right? And we have a global bull market in equities, and we have a global growth cycle, and they're complementary, and they reinforce each other through the earnings cycle. And so for us, we're really looking at opportunities now outside the U.S. We think we're going to shift. The equity market's going to broaden out. Global growth is going to broaden out. And the opportunity set really is more attractive, more attractively valued, under-owned, upcycle in growth and earnings in the non-U.S. market. So we're really thinking about shifting from U.S., which has been the leader, to the non-U.S. markets.
All right, hold those thoughts. We're going to dive into more of them in just a moment. As Jay said, of course, the S&P 500 has had a fantastic year, up more than 25%. Futures, though, this morning, on this Thursday morning, are pulling back. We are seeing red across the future screen. S&P 500 futures there, down 0.3%. Euro dollar back at 104. I keep coming back to the fact that we started the year with euro dollar around 110. So we've just seen the U.S. dollar on an absolute tear, but also a lot of problems right now happening in Europe. Yields climbing this morning, up more than 3 basis points, 4.62% on the 10-year yield. T. Rowe Price looking for something like 5, maybe even 6% in 2025. And New York crude firmer, more than $70 a barrel on NYMEX crude. Coming up this hour, Andrew Obin of BofA Securities on the outlook for industrials amid Trump's tariff threats. Joe Brasuelis of RSM reacting to the final jobless claims data of the year. That's coming up in about 30 minutes. And Chen Zhao of Redfin Economics on the state of the housing market going into next year. We begin this hour with stocks on track for their second straight year of 20% plus gains. Jay Pawlowski is bullish going into the new year, saying, quote, "We continue to expect single-digit type upside for U.S. equities next year, but we think there is a reasonable chance that at the same time, investor concerns over the likely policy chaos in D.C. could lead to investor outflows from heavily over-owned U.S. assets, resulting in USD weakness, which would further support commodities and EM assets." And Jay, I'm so excited, is going to join us for the next 60 minutes. So what you're saying there, what it sounds like is almost 2024 was the peak when it comes to U.S. exceptionalism. Is that accurate?
Well, it could be, right? I mean, U.S. has led. I mean, it's one of the things that's interesting. We talked about those big moments, right? One of them was election night, where we talked about the great economic story of the Biden administration did not translate politically. But clearly, the U.S. is the global growth leader, best performer on inflation. And yet now we're looking at a situation where we think there's uncertainty in the U.S. With the new administration. The rest of the world is responding, right? We're in what we call, as we touched on at the top, the long cycle. It's really being driven by competition within our tripolar world thesis of regional competition between Asia, Europe, and the Americas in the 3 areas of climate, AI, and defense. And that competition requires a new industrial policy. So we're talking about the marriage of fiscal and monetary policy, and it has to be done well, right? And so you really have to start putting a premium on the policymakers and their ability to be in alignment with public and private sector. And we see that in China, right? You were talking earlier about the EVs. China led the way in the climate space, and they now dominate the entire space. So now the fight is in AI. And people are throwing money at this. Every government, every company in the world needs to compete in AI. And so these investments are too big for any one company. That's why the governments have to get involved. That's why we have fiscal spending. But you have to do it well. And if you don't do it well, the markets rebel, as we're seeing in Brazil, right? 9-10% fiscal deficit, currency collapsing, rates skyrocketing, and equities underperforming. And so there really is this competition. And we think we're shifting now where the rest of the world has to respond. So you have deflation in China, you have stagnation in Europe, and so we're seeing policy mixes responding now to those issues. And we see President-elect Trump as an accelerator of that, right? I mean, he's threatening tariffs on everybody. So people, China in particular, export-led economy. If they don't start to drive domestic consumption, they're more at risk to being held hostage by the U.S. And so they are responding. And one of the great unknowns, we talk about the U.S. and the S&P. Guess what? China is outperforming the U.S., right? FXI, the large cap China ETF, is up 29% year to date, outperforming the S&P. Nobody knows about that. Nobody talks about that. But that's the reality. So it's already starting to happen. And so our view is that year 3 in a bull market, which is what we're in the US and globally, tends to be a kind of rest year. Single-digit type returns are the average for 3-year bull markets. So as we see global growth picking up outside the US, we think we're going to see earnings do better outside the US than in the US. That's new, particularly in emerging markets. And therefore, we think investors can start to take profits in the US, particularly if there's uncertainty with the new Trump administration, and allocate to the non-US markets, which are completely underowned at like 50-year lows in relative valuation, starting to pick up earnings growth, starting to do the right policy mix. So that's the opportunity. Take some money off the table in the US, move it into the non-US markets, and we think commodities as well. And so there's really that pause. So year 3 in the US bull market, single-digit earnings growth. That's what we're driving with our single-digit return expectation. And then non-US markets can go up 15%, 18%, earnings growth, economic growth, investors start to allocate. There you go.
Let's look at China a little bit more, though. I know the equity market there, you say, is doing very well, but the economy there is still struggling. Don't you think? I mean, you look at youth
5% growth.
You look at consumer healthy or not, consumer demand, it's not really there. I mean, at some point, do you think China is going to come out with an even bigger bazooka when it comes to fiscal demand?
Well, a lot of it, as we've talked about, Emery, is what's in the price, right? And, the China stimulus, they are taking out the left tail risk. They've told you months ago that they're not going to let the equity market go down. And guess what? They have the ability to do that. And so they're doing it. And so as an investor, when you look at single-digit PE, which is what, China trades on, when you look at the government saying we're going to stimulate the economy, when you look at the tech stuff, right? So the U.S. is trying to freeze China out of the high-end tech so it could lead in AI. That's the game. The way we look at that is that's an opportunity to buy China tech, which is now going to dominate the China
national champion.
Yeah, the China e-commerce market, which is much bigger than the U.S., growing much faster than the U.S., and the companies that dominate them are trading at like a 60% discount to the U.S. peer group. And so we're long China tech because we think that's really where the opportunity is. And as we said before, China knows it has to act because it's struggling with deflation, right? The property sector has been a big problem. By the way, it's bottoming. You can start, the data is starting to finally show properties starting to pick up a little bit in China. And now we have a situation where they are threatened by President Trump with exports, okay? They're an export-led economy. They need to switch that export focus to domestic demand focus. And that's what they are doing. So stimulus, 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 not a huge bazooka. We don't expect that. But stimulus, 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 more stimulus coming in the spring, and therefore, growing at 5%, earnings growth needs to pick up. So that's important. Earnings growth has been disappointing in China, but we think it's going to pick up, and as it does, stocks are completely underowned. Nobody owns China. I mean, I saw something, and I can't remember which firm because, so many year-ahead outlooks, and I think there was a list of like 15 major banks, and not a single one thought China growth was going to be better in 2025 than it is in 2024. I love that. When everybody is thinking one thing, we like to go the other way.
Right, when everyone's on one side of the boat,
Yes.
you lean the other way.
Yes.
Okay, so we talked about China. You have this idea that potentially they'll have domestic consumption, try to boost it. At the same time, many say that with the walls going up around the United States, they dump more on Europe. Can Europe handle that?
Yeah, Europe is a challenge, right? So in our tripolar world, you have China leading because they're the best at marrying this industrial policy, fiscal and monetary, public and private. They've shown that with the climate space, right? U.S. responds with Biden's CHIP Act, Infrastructure Act, IRA Act, and now we're in the game. Best growth of the G7. And now where is Europe? So Europe has to respond. They know it. There's report after report, the Draghi report, this, that, and the other. They know what they have to do. It's a matter of political will. And I think you're going to see that political kind of logjam break this spring in Germany. Germany is the engine of Europe, and it's been going nowhere for years. Okay, in part because Germany has not gone down the fiscal stimulus route that pretty much every other major economy has. They have the famous debt brake, right? Very strict on how much debt they can issue. So guess what? They now understand they have to kind of fudge that a little bit, and they need to stimulate to get their economy to pick up, because they too, like China, are very export dependent. And their export dependency is on China. So China's weak consumption really hurts Germany. All right. So we expect in the upcoming election, right, the government has failed. We wrote a piece last week in our musings. It was called Vote of No Confidence, right? Because there's so many no confidence votes. And Germany had one. New government we expect in the spring, going to be led by the more conservative side of Europe, German political space. And we think they are going to lead the talk about easing on the debt brake. So we expect fiscal stimulus in Germany next year, in Europe more broadly, and we think that is going to help attract capital to the European assets.
How behind are they potentially going to be, though?
Well,
Donald Trump is being inaugurated January 20th, and he has a very different view on Europe than the Biden administration.
Well, I mean, look, I think the tariff thing is overstated. Let me just go back to the Europe and Germany 1 sec. Really, the auto companies show it, right? That is the leading edge of European manufacturing. And they are getting their heads handed to them all around the world, but especially in China. So they know, they understand, they have got to act, and they're going to act. On the tariff side, I think the markets are telling you that for the most part, it's already in the price, right? Trump came out 25% on Mexico, on Canada, more on China.
He's already negotiating.
Right, but here's the thing. It's not the news. It's the reaction to the news that counts. And you look at the reaction to these markets, there was no reaction. No reaction. Peso higher after a week, China stocks higher after a week, Europe no stocks, no action. So I think the tariffs for the most part are in the price.
Jay Pulaski, thank you so much. And you'll be sticking with us for the next 60 minutes. That's Jay Pulaski of TPW Advisory. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. President-elect Donald Trump has tapped Miami-Dade County Commissioner Kevin Marino Cabrera as ambassador to Panama. Cabrera worked for the Trump campaign in the 2020 presidential election and won Trump's endorsement when he ran for vice chairman of the Florida Republican Party in January. Cabrera has his work cut out for him as Trump calls for the U.S. to regain control over the Panama Canal. Meanwhile, Bitcoin reversing earlier gains, though it is up on the month after the digital asset stockpiler MicroStrategy announced a plan to issue more shares in a move that would allow it to buy even more tokens. But MicroStrategy raised some eyebrows earlier this week when it announced it had purchased more Bitcoin, but it was its smallest purchase to date and at a very high price, which is unusual for the company known to strategically buy the token on the dip. And Elon Musk's deputy, Steve Davis, is helping recruit staff for President-elect Donald Trump's Department of Government Efficiency, also known as DOGE. This is in addition to Davis's day job as president of Musk's tunneling startup, The Boring Company. Davis has helped Musk cut costs at businesses, including SpaceX and social media platform X. That's your Bloomberg Brief. Anne-Marie?
Thanks so much, Yahira. Up next, we're going to be sticking with President-elect Trump and preparing for Trump's tariffs.
I think what you're seeing is a pull forward, so it's taking share from the future, that people are trying to get goods in before a potential strike or tariffs.
That conversation coming up next. You're watching Bloomberg Surveillance. Good morning and welcome to Bloomberg Surveillance, the final week of 2024. We are seeing markets pull back ever so slightly, softer on S&P 500 futures, but an incredible year with S&P 500 up more than 25% this year. Eurodollar sitting around 104. Yields, though, climbing this morning, up nearly 4 basis points on the 10-year. You're looking at a 10-year yield of 4.62%. Under surveillance this morning, preparing for Trump's tariffs.
I think what you're seeing is a pull forward, so it's taking share from the future, that people are trying to get goods in before a potential strike or tariffs. That if you're concerned about those things, which you should be, and you have the option, you have the flexibility in your supply chain, you want to get the goods in as soon as possible to avoid the disruption. The big thing right now is the uncertainty. It's like, what exactly is going to hit? When is it going to hit? How is it going to hit?
Here's the latest. President-elect Donald Trump proposing tariffs on Canada, Mexico, China, and the European Union, resulting in more questions than answers about how his administration will implement them and how fast. Andrew Obin of Bank of America Securities writing this. Overall, tariffs are likely manageable for multi-industrials. That said, we believe tariffs would be a negative headline for our stocks, and there's a potential for a price-cost air pocket. Andrew joins us now. Thank you so much, Andrew, for joining us. So explain that air cost.
Yeah, sure. Look, I mean, roughly 20% of COGS for multi-industrials are imported goods. So from that perspective, as you start putting in tariffs, you have to price for them. And the question is, how long does it takes for the pricing to go through? Last time, what's interesting, stocks actually did go down on these negative headlines in 18 and 19, right? Remember, but those were China-oriented, right? We had 25% tariff on $200 billion worth of goods imported from China. Then we did another 10% on $300 billion in 2019. And if you actually track the stock reactions on that day, and if you traded that basket, I think on a cumulative basis, stocks underperformed by 16 percentage points on the days the tariffs have been announced. However, this time it doesn't seem like the market cares too much.
Why is that? Why is the market just brushing it off?
I think it's complacency. I actually think, I do think longer term, what people saw last time is that the companies were able to implement price increases to offset that. So, for example, if you think about 20% of COGS, takes 1.3 percentage point of price to offset that, and 1.6 percentage point of price for you not to even see it in the margin. So from that perspective, what we've learned over the past 4 or 5 years during COVID, right, very inflationary companies are a lot better in putting pricing in. So I think people just think companies have developed this pricing muscle to put that in.
So Andrew, is there one part of the world that's better positioned to deal with tariffs? Like, is China better prepared, or is Europe better prepared, or do you think everyone's kind of equally unprepared?
I would say it's more, our comment is more about investors, right? Because you sort of think that tariffs don't matter. When we talk, so I cover a truck distributor, and you talk to them, and they source trucks from Mexico and they source trucks from Canada. They actually, this is like real operational stuff. They have no clue what's going to happen the day the tariffs go in. So I think the market is missing also that part about the actual disruption when that happens. Yes, they'll put in pricing, right? But you talk to the executives, and they're a bit at a loss as to what's going to happen the day of the tariffs, because they have to manage in the real world, right? Right. For these numbers to show up, for this pricing to show up that quarter later, actions have to be taken, right? And then there are supply chain disruptions. I think it's actually the nuts and bolts of tackling whatever disruptions there are, if there are in fact tariffs in place.
Right. So, because it's interesting, because I've had the view, and I expressed it a few minutes ago, that I think markets have already kind of priced in the tariffs. So I'm on a different wavelength than you. So it's interesting, your view.
Yeah, I would not disagree. So we published this year ahead report, and then we surveyed investor sentiment. Nobody cares about tariffs. I think it's actually very fair. Investors are very complacent about tariffs. I think that's the part that concerns me, right? I do think they're manageable. I think it will take 1 to 2 quarters to fully offset tariffs with pricing. We are in the inflationary environment. The companies have gotten way better at putting in pricing. But what happens, right, that quarter when you miss numbers on tariffs?
Right. So I want to get to that, because you talked about your basket and what happens, the underperformance if you bought on that day. I'm curious, have you done work on like 3 months or 6 months or 9 months later? Was that actually a buying opportunity?
Yeah. No, I mean, look, the background for our call is that we have the best CapEx cycle probably in 20 years. And obviously tariffs is part of the policy. The US government decided, since the 50s or 60s, we finally have an industrial policy, right? And the industrial policy, the gist of it, we're not going to deindustrialize. And from that perspective, what it means, I think it is very fair that investors are taking this view. Look, this is part of this much broader thesis. Story, if you look, between 2007 and 2019, I think US CapEx has grown 3%. If you look in the past 5 years, it has compounded at 7%. Now, part of it is inflation, but obviously we report numbers. Earnings are with inflation.
Exactly.
So that matters. We probably will end 24 with 9% CapEx growth. 25 is going to be another year of high single-digit capex growth, right? So tariffs are disruptive, but they are driving this massive, massive structural change in capex in North America, right? Driven by semis. But what's also interesting is that semis is dragging along with it huge, huge part of the supply chain.
Perfect. Andrew, do you have a time frame on when we could see the sanctions, the tariffs?
No, I honestly don't, right? You don't know what's going to happen after January 20th.
So companies are struggling to prepare.
Well, I think it's the uncertainty. It's exactly right. Going back to the example of the distributor I gave you, right? They source trucks from Mexico, source trucks from Canada. What happens the day off, right? Because they have to go to their customers. They have agreements signed. So how do they deal with that, right? They have to go to their customers. They have to explain what happens. I do think the managements are a lot more ready. We had a dinner recently with the CEO, and we asked him, how long will it take you to put in tariffs? And he said, I'll put them on day one. I'll put in pricing day one to fully offset. I'm not going to apologize. I think the upside is that we are coming off this highly inflationary environment, right, where companies have absolutely developed this pricing muscle, which was not there in 1819, which was right at the tail end of this big deflationary cycle.
When you're looking into next year, 2024, you talk about secular themes like electrical, data centers, grid. What do you expect some of those themes to be going into 2025?
Oh, we think the theme is very simple. It's PMI. PMIs have been down for 2 years. There are multiple reasons. There are technical reasons, definitional reasons why they were down. I don't think it really reflects how weak the industrial economy is, but history tells you if you have PMI going over 50, if we don't have a recession, PMIs go over 50. I think since the 60s, average outperformance has been 9 percentage points. Average absolute performance has been 20% plus. So I think investors are just waiting for the PMI to turn over 50. And I think that's probably the biggest theme into 2025. We expect that to happen maybe sometime in April. Having said that, I would say grid story is probably the biggest visibility story we have over the next decade. Decades and decades of underinvestment. And you have the confluence of reshoring and hence, tariffs, right? You have electrification, you have EVs, you have data centers, right? All of this comes together. So to us, grid epitomizes the confluence of all these mega trends that you talk about, and you really do have visibility for the next decade, because the last time we invested in the grid was in the 60s and 70s, and the stuff is just getting older and it's falling apart.
Andrew, thank you so much for your time this morning. Interesting stuff. Andrew Obin of Bank of America Research saying investors may be complacent when it comes to the upcoming potential tariffs. Coming up next, the final U.S. jobless claims print of the year, and Joe Brusuelas of RSM breaks down the data for us. You're watching Bloomberg Surveillance. Good morning and welcome to Bloomberg Surveillance. We're about 20 seconds away from the final U.S. jobless claims data of the year. Right now, what we're seeing across equity futures is a pullback. We are softer on the day. The last week of trading for 2024, we went into Christmas with a high. S&P 500 went into Christmas up more than 1%. Now we're pulling back 0.3%, but really not a ton of drama, as Jonathan Farrow would say on this Thursday morning. What we're seeing across yields, though, yields are climbing this morning. We have 4.6% on the 10-year yield, up more than 3 basis points. And we are seeing a little bit softer weakness on euro dollar. It's been a story of 2024, just absolute insatiable demand for the U.S. dollar. We have had that claims data drop, initial jobless claims, coming in at 219,000 for the initial jobless claims. The survey was for 223, so this is actually coming in lighter than expected. Prior month was 220K. We should remind you, claims data does tend to fluctuate, especially around the holidays, and you do see S&P futures there still are negative around 0.3%. Joining us now is Joe Brusuelas, chief economist at RSM. Joe, let's just get your first reaction to initial jobless claims, the final print for jobless claims of the year, coming in at 219,000.
Well, I think you laid the predicate there for me very well. Thank you, Anne-Marie. Good morning and happy holidays to everybody out there. You know, what we're seeing is a continuation of holiday noise. We get this time of the year. What I tend to do is look at the 13-week moving average, which was just above 220. So my sense is that we have gotten another status quo report. The U.S. economy continues to do well, and firms carefully manage their labor force, because as we head into next year, we do have not a risk to the downside. You know, we don't think that there's much risk of a recession next year, only 15%. We actually think the economy could outperform again, maybe even above 3%, and that would mean an acceleration in hiring. So we expect more of the same as we enter 2025.
When you look at the labor market, do you think right now the leverage is with the employer or the employee?
I think it's pretty finely balanced right now. It's no longer heavily tilted in favor of the employee like it was during the pandemic or in the initial recovery phase. My sense here, though, is that those days of very heady wage increases are behind us. We're really going to see 3.5% to 4%, I think, on a sustained basis. Now, if you're managing a firm out there in the real economy and you expect wage gains to reset to a pre-pandemic level, say of 2%, I suggest you might want to revisit those assumptions, because I just don't think that's where we're going to be for the foreseeable future.
Hey, Joe, Jay Pulaski here. You talk about 3% growth, which is well above potential. Are you worried about inflation next year?
All right, so the way we look at next year is our baseline was a 55% probability that the economy grows at 2.5% or better. But, as we accelerate into the close of the year, we're thinking about that alternative to the baseline, which was a 30% probability that the economy would grow at a 3% or greater pace. At that point, yeah, I would be concerned about an acceleration in inflation, not just because of the underlying fundamentals, but because of the policy adjustment that's going to go on in Washington. That's going to be some of the main variables that we're all going to have to solve for next year.
Yeah, and thinking about that a little bit, do you have a 10-year yield forecast? Because I'm curious.
Sure.
What you think about the rates at that, if you do get that inflation?
For 2024, our forecast was 4.2 on average. Just before the show, I looked at the average on the 10-year is at 4.19. So we're very confident in our forecast for 2025. Right now, we thought we'd average 4.5% with risk of moving to 5% or higher. We thought the 10-year would trade somewhere between 4.3 and 4.70. So you look at that 4.6, and I think we're tentatively moving towards oversold conditions in the fixed income market. I think that, thin holiday trading conditions tend to cause things to melt up. And we've seen the stock market melt up over the past week, and we certainly have seen yields melt up. I don't necessarily think that's sustainable. I understand there's considerable uncertainty, and perhaps we should start talking about an uncertainty tax on fixed income. But my sense is that, yeah, you're going to see that 4.5% more or less next year. Now, you set me up there, so you open the door and I got to walk through. Should we move to 5% or higher? That's when things begin to break.
Right.
On top, around our very optimistic forecast on growth at somewhere between 2.5% and 3%, we do think that there's going to be some problems. Should yields on the 10-year move above 5% specifically in local and regional banks who are holding a disproportionate percentage, around 70% of commercial real estate loans. Some of those are simply just not performing right now as we continue to move through the adjustment in CRE. That's going to be one of the issues. And remember, the last time we moved above 5%, well, we had a mini bank run on those local and regional banks. The Fed had to step in and set up a liquidity facility. It'd be better if we didn't revisit that, in my estimation.
Do you think the bond market, specifically the 10-year yield, potentially around, if it were to trade near that 5% level yet again, will that be the ultimate check on some of the fiscal policies coming out of Washington?
Well, that's certainly going to be the discussion, isn't it, Anne-Marie, that the bond market's the last check on the expansionary fiscal policy of the new administration. One of the things that's not yet been really talked about to my satisfaction is the internal contradictions inside economic populism as it's practiced here in Washington. We're going to see tax cuts. We're likely to see an increase in government spending, most of it government financed, right? So you're going to see increased spending. You're going to see that stronger dollar. It's going to attract capital. But that's not going to rebalance the economy. And the bond market we'll make a reassessment of the administration once we get the first set of concrete policy proposals. We're all basically thinking about this, but until you can see the whites of the eyes of the policy, it's going to be difficult to make a real hardcore assessment of where yield should be, where the dollar should be.
It's an interesting point because we do have some members of the FOMC, Joe, actually trying to make assumptions about what policy will look like next year. What did you make of that? Some members of the FOMC starting to pencil in what Trump policies might mean for 2025.
Well, I think it's appropriate that they begin to think about it. I didn't necessarily see it embedded in the forecast in the December summary of economic projections, but I think it's good that they begin to talk about it. When it comes down to what the Fed's going to do, I'll listen to Austin Goolsbee, Williams at New York Fed, and of course, Jay Powell. And Powell was very clear. Yeah, we're thinking about it, but we have not altered our forecast based on what's likely to happen. Now, from my point of view, I think the only thing that we can take as certain is that there's going to be tax cuts. The question is, are they going to be partially paid for, or are they going to be 100% financed? I happen to be here in Washington, D.C., visiting some relatives. It's, it's one of the topics around the dinner table. My sense is that the majority next year will lean towards financing that, and that will point yields in a higher direction.
So, Joe, what does that do for the dollar? I'm curious. You had a great call there, obviously, on the 10-year. I imagine you have a view on the dollar. I'd love to hear it.
So we had a much stronger dollar for the first 6 months of the year against a trade-weighted basket of currencies. You're going to continue to see growth differentials and interest rate differentials drive the value of the greenback. The question is not will the dollar get strong, but will we get in a situation where the fundamental underlying strength of the U.S. economy, with that new policy piled on top of it, turns us into a situation where the dollar soars in the 80s and we get calls for dollar devaluation. The reason why I point that out is if you listen to what the incoming Treasury Secretary nominee has said over the past number of years, he clearly thinks that the dollar is overvalued. So we'll have to wait and see. And of course, the ultimate decider, President-elect Trump, he doesn't want to see dollar valuation. So we're going to see policy perhaps at cross currents, and we'll have to see which one wins out. But I would expect the dollar to gain against the euro, the yen, especially the peso, the loonie in particular, as well as a number of other currencies. Let me give you one you want to watch. Indian rupee. Now that's at or near all-time lows as that economy decelerates from somewhere near 7 to 10% to somewhere probably closer to 5%. That's indicative of what's going on in emerging markets where we could have a shakeout. Jay, one of the interesting things is through mid-year, interest rate differentials and growth differentials have driven capital flows into a particularly interesting situation where capital flows in the United States are larger than the next 12 economies combined. That's something that's not sustainable and will create issues for emerging markets as we all adjust to the new policy environment in 2025.
Joe, thank you so much for your time this morning and spending your day after Christmas with us. Joe Bruce-Wallace of RSM. Let's get you an update on other stories you need to be watching out for this morning. Here's your Bloomberg Brief with Yahira Hackes. Hey, Yahira.
Hi, Anne-Marie. Russia launched a large-scale missile attack on Ukraine's energy infrastructure yesterday. The assault prompted the local power grid operator to limit supplies, leaving 500,000 people without heat amid the bitter cold. The attack included 70 missiles and more than 100 attack drones, according to Ukrainian President Volodymyr Zelensky. U.S. President Joe Biden called Russia's Christmas Day attack outrageous and vowed continued U.S. weapons deliveries. Meanwhile, the U.S. will bring back family detention centers when President-elect Donald Trump returns to the office. That's according to the incoming White House border czar, Tom Homan. In an interview with the Washington Post, Homan said U.S. immigration authorities will look to put families with children in soft-sided tents and will not hesitate to deport parents who are in the country illegally. And the Baltimore Ravens with a decisive road win over the Houston Texans in the second NFL game on Christmas Day. Houston was no match for Baltimore's running game, with Derrick Henry topping 140 yards on the ground and scoring a touchdown. Reigning league MVP Lamar Jackson added 87 rushing yards and a touchdown of his own and became the NFL's all-time leading rushing quarterback. topping the previous record holder, Michael Vick. Baltimore now moves closer to locking down the division title after Pittsburgh's loss to Kansas City. That's your Bloomberg Brief. Anne-Marie?
Thanks so much, Yahira. Coming up on the program, Redfin's Chen Zhao joins us with her 2025 outlook for the housing market. That's coming up next right here on Bloomberg Surveillance. Good morning and welcome to Bloomberg Surveillance. We did get initial jobless claims come through, softer than what the market was expecting. Futures this morning are pulling back slightly. We are in the red. S&P 500 futures down nearly 0.4% this morning. Yields, though, that's where the action is this morning, climbing on the 10-year, up more than 4 basis points, 4.62%. Turning now to the housing market. Chen Zhao of Redfin Economics noting the Fed's less dovish stance, warning, quote, this hawkish stance from the Fed will keep mortgage rates high until there is data showing a weaker economy and or the incoming administration dials back their plans for policy changes, especially on tariffs. Chen joins us now. Chen, when you look at the mortgage rates, they're basically the same from the January 2024 to December 2024. Is there any glimmer of hopes for those trying to buy a house in 2025?
Good morning. Thanks so much for having me. So you're absolutely right. Mortgage rates for really the last couple of years has, bounced around a lot, but they've generally stayed pretty high. And we're ending the year with pretty high mortgage rates. As we're looking into 2025, what we're expecting is that mortgage rates are probably going to be volatile, similar to what we've seen, but that they're probably also going to remain pretty high. We don't really see a lot of room for rates to fall. We heard from the Fed just very recently. And, they're not expecting to cut their policy rate very much. And even if they do, there's already, 1 to 2 cuts priced in. And long-term rates like mortgage rates are influenced by a lot of other factors beyond the Fed's policy.
What about actual house pricing? If you cannot get a deal when it comes to mortgage rates, is potentially there room for negotiation when it comes to the cost of housing?
So, inventory is still constrained, and that's what's really been keeping home prices high. So we expect that home prices will continue to rise in 2025, around the same rate that they're rising right now, which is about 4 to 5%. So we might get maybe a little bit of a slower home price increase into next year. And that might be because we get just a little bit more inventory. As time goes on, we do expect that more sellers, existing homeowners will become sellers as, life circumstances force them to really move. So with that, I think that is a little bit of a glimmer of hope for buyers in the sense that hopefully next year there's a little bit more selection as they are, looking around the housing market, even if prices continue to be high and mortgage rates are likely to be high as well.
Jen, Jay here. What are you looking for in terms of new home construction? Are you constructive on an increase in the number of new homes built next year?
We do think that that is possible. We think that in the short term, you might see a little bit of an increase, but also in the more medium to long run, if the new administration does bring about more deregulation and lowers the cost of constructing new homes, you could definitely see more home construction in the more longer term. However, that's going to take longer to play out in terms of as an affordability relief for home buyers.
So one of the, when we think of things big picture wise, we look at construction and employment as kind of a leading indicator traditionally, right, to a weak labor market. It sounds like you're not expecting problems in the construction side in terms of employment.
Well, I think there's a lot of uncertainty right now, right, as we're rounding the bend into a new administration. So the labor market certainly remains strong. However, the construction industry does also rely heavily on immigrant labor. So depending on how the new administration chooses to carry out its plans around immigration, I think that could certainly have an effect on the housing market.
You also think that 2025 will be a renter's market. Why is that? Is that because just owning a home becomes so elusive for so many people?
Yes. So I think we're starting to see that wedge in affordability between buying a home and renting is really increasing, and we expect that to continue in 2025. So after the pandemic, so during the pandemic, rents rose a lot, but home prices also rose a lot. But the difference is that after the pandemic in the last couple of years, we also had mortgage rates shoot up. So that's just brought the for sale market, in terms of affordability to really kind of like these sort of off the charts numbers. And that's been a real challenge for home buyers, especially first time home buyers who have not benefited from equity gains on their existing properties. But on the rental side, what we've seen is that a lot of the, boom in multifamily construction, that has really paid dividends for renters in the sense that rents have stayed pretty flat for the last couple of years. In our Redfin data on the rental market, what we've seen is that right now rents are probably around the same level they were about 2 years ago. And we expect that to continue into 2025 as there is still more supply coming onto the market. So that is why we're saying 2025 could really be a renter's market.
Your prediction number 10 on your list is Gen Z will rewrite the American dream. What do you mean by that?
We mean that the American dream has, in general, historically always included buying your first home. However, as this wedge between the affordability in the housing market and the rental market continues to increase, what we think will happen is that for a lot of the younger generation, they will continue to rent for longer. But that doesn't necessarily mean that they can't build wealth. They can still continue to build wealth in other ways, but it just won't necessarily be through the housing market as much as for previous generations.
Chen, quick question on rates. Is there a mortgage rate level that you think really freezes the market?
Well, so what we're seeing right now at the end of 2024 is that mortgage rates are right around 7%, but we've seen a real pickup in activity. So, NAR just released their November existing home sales, and that increased above 4 million for the first time since the springtime. Our Redfin pending sales data is up about 4 to 5% year over year. We're also seeing increased demand for tours from our agents since the November election. So it does seem like the same pattern that we've seen between mortgage rates and housing market activity, it's changing a little bit now since we've had high rates for so long. However, I do think that, if rates go much higher above where they are right now, maybe if we get closer to 7.5%, that would really put a freeze on the housing market.
You talked about labor as being an issue with the incoming administration's immigration policy mix. Is there also a concern about tariffs on places like Canada in terms of timber and wood? I'm just curious. It's not my area of expertise, but do we import a lot of wood from Canada that could have a major tariff slapped on it?
Yes, I think that with the new incoming administration, there's a kind of a bag of different policy ideas that they are just talking about. So there are some things that would definitely be a tailwind for the housing market in terms of, deregulating and kind of like lowering the costs for construction. However, you could potentially also see some headwinds, and those would come in the form of any restrictions on immigration or, as you point out, tariffs on that would increase the prices for building materials. So anything that really increases the cost for building housing, that would definitely put a damper on the housing market. And not having enough housing is really kind of the root cause of a lot of the problems that we have in the housing market.
Chen, just briefly, to wrap us up, what are the hottest 3 housing markets right now in the United States?
So, where we're really seeing the most activity right now is in a lot of more affordable markets. So those are going to be places that are in the Midwest or in the Northeast, where you still have a lot of demand and you have demographic tailwinds, but there hasn't been a lot of new construction, which is what you've seen in, for example, the Sun Belt, where you see a lot of cooler housing markets.
Chen, thank you so much for joining us to this morning. Chen Zhao of Redfin Economics. Of course, a lot of people are looking for places where they can actually get on the housing market. If you look at these mortgage rates, they're basically the same coming into 2024 as they are leaving 2024. Jay Ploski, thank you for joining us for the 60 Minutes. As we look ahead to 2025, what's your top piece of advice? What are you focused on?
Well, look, we've had a great year. We're getting ready for Q4 earnings. Earnings have been the support for equities, particularly in the U.S., also globally. We're really watching 4 indicators right now. So one is the China long bond, right? It's had a huge rally. We need that rally to reverse to show that the stimulus that China is putting into place is actually starting to bite, right? So we want rates going up in China. We want to see the commodity sector get back above its 200-day resistance, right? Commodities will suggest that the global growth picture that we think is pretty constructive is in fact correct. So we want to watch commodities. Then we want to watch emerging markets. We think emerging markets could be the place to be next year. And right now we look at China, as we talked about earlier, China outperforming the U.S., China leading EM. We want to see EM get above their technical levels. And the last thing, which we've touched on a couple of times throughout the hour, is the dollar, right? How does all this play out in the dollar? Right now, the dollar is kind of pressing up against important technical levels, which if it breaks through 109, that means it's going higher, and that's a problem for our mix on EM and non-U.S. markets.
So you're looking to see potentially 2024 being peak U.S. dollar?
Well, peak exceptionalism, right? U.S. is priced for exceptionalism. Are we going to be exceptional relative to the rest of the world going forward? We think that balance is going to tilt more towards the rest of the world.
It'll be a fascinating year. Jay, thank you so much for ending 2024 with me and for joining us this past hour. Coming up tomorrow, I'll be back in the studio. Marvin Lowe of State Street will be joining us alongside Dan Ives of Wedbush, Dan Greenhouse of Solus, and Anna Rathbun of CBiz. This was Bloomberg Surveillance as we set you up for the cash equity market open in just about 40 minutes time. You are seeing futures pull back today. Not exactly the Santa Claus rally that everyone was hoping for today. Still a few days left though for 2024. S&P 500 futures down 0.4%. This is Bloomberg.